Very good morning to you. Welcome to Trade Live with IG with myself, Rich McDonald, and
Ronnie Agnig.
That's the one.
Your favorite co-host, right?
My favourite on a Wednesday in July when there's a number 16 in front of it.
So I'll take it.
We've got, whoa, who bought at 6,300 yesterday? Go on, who bought from me? Smashing those futures out when that inflation number, 0.3% inflation month on month, and a higher than last read, and people bought the futures on it. Are they mad?
Seems like they are. And it seems like Daddy Trump is also mad, but we'll get into that later on.
Jamie Dimon not happy with them. Right, let's look at what is getting up, coming up on today's show. Who's getting up? Here he is then, Ronnie the man. You're doing fast markets with Angelina. I didn't realise that.
Nor did I.
All prepared for that, Ronnie?
Yeah, I mean, as prepared as I can be, you know, I'll do my very best.
It's because Axel Rudolph takes over at 8:30 on to charting crypto. And coming up 9 o'clock, of course, we've got those all sessions. The futures looking down 20 basis points again. It's exciting me. Can you tell that we actually saw a high put in the market yesterday? The flag is in the top. 9:10, Macroscope, Aaron Bright and Martin Harris. Oh, that's clever.
Yeah, surprisingly, actually, well done.
Under the Macroscope. Who came up with that idea?
Good question. Maybe one of the 16 people working on the marketing team got together, brainstormed.
You think it was one of the viewers? Well done, that is a great one. Under the Macroscope. And 9:35, Julie Lepselter is back in the building all the way from Chicago. She is in to help Angeline go through Trader Tools.
Is she from Tasty?
Have you not met Julie? She sits about... Honestly, she could hit you with a tennis ball from where she sits.
So it's a massive office, so crowded.
Right. We've got inflation problems. Let's go into overnight action.
Come on, lads.
So we had US CPI yesterday. That wasn't great. Oh, we stuck on that, are we? There we go. Cam and Terence in this morning.
Clearly.
I walked in this morning. I get in about 6:15, and Terence is sitting there with a muffin. How can you be eating a muffin for breakfast?
Kids these days, eh?
Honestly.
Back in our day, 2 hard-boiled eggs and some jelly deal.
It's a jelly deal. Is that what you actually had in Aberdeen?
No, we actually had a full Scottish fry-up. Me and my mates actually had a Scottish fry-up review. So we visited like all the Scottish fry-up places in Aberdeen and ranked them.
That's been quite a lot.
Yeah, we got busy.
That was your university days. That's how you spent them.
That's how I spent the student grants. Thank you, students' government, for that.
Now you know why you're at the gym every morning. Right, let's take a look at those inflation numbers then. There we go, 0.3% month on month, 2.7%. That was up from 2.4 the month before, 2.3 the month before that. I don't think we're meant to be going higher. That's not the direction of travel we want to take, Ronnie.
You know what? What's really shocking to me and surprising is that if you impose tariffs on other countries and you start making every product more expensive, that the prices are passed on to the consumer and the prices rise. I'm really surprised,
If only there was a way of measuring that month on month.
Imagine. I'm so surprised to see that this is actually going up. Why isn't Jay Powell cutting the rates?
And because it's his fault.
Oh, right.
So yeah.
Sorry.
It's his fault that prices are going higher and inflation's going higher, and therefore Trump's cost of funding that big, beautiful debt is also going higher as well. Jamie Dimon yesterday saying, Donald, stop messing with the Fed. Just be careful what you're seeing, because the consequences can sometimes be opposite of what you are intending. So why can't we just have more people like Jamie Dimon, Scott Bessent, just in charge.
The problem is that even if they are in charge, will it be implemented? Will we have, a president who actually listens? But yeah, you know what? I think I want to circle back to the conversation we had a few weeks ago about how many rate cuts we're going to have in the US this year. And with this data, it looks like I might turn out correct with 0.
Could well be. Certainly there's a chance that we get 0 more right here in the UK, because let's take a look at how UK CPI has come out this morning. If you're long pounds, as most of us are, then you should be happy with this, because the pound has gone stronger on the fact inflation came 0.2% higher than expected year on year in both the headline and the core. And month on month there, 0.3, 0.4 in the core. This is really not a good 24-hour period for doves, for people looking for rates coming lower. And if I was a mortgage holder, I would be worried with that path of travel.
Yeah, it's surprising to see that, despite all of this, we're still getting higher inflation. It continues to go upwards. But what is also worrying, if you look at the banks are not even, they're quite mixed results across the banks. The US banks had earnings out yesterday, and they still had mixed results as well. So looking at the data and then looking at where we're heading in the direction of inflation, I'm not really optimistic in anything when it comes to either rate cuts or...
At the same time as slower growth. That's the real problem. That is why I'm so bearish and I am crowing this morning, because
give me your pen.
We are going into a period of higher inflation and slower growth. That is not what markets enjoy. Equity markets hitting 6,300 yesterday, and now we're at 6,227. That is a retracement that you see at the top of markets. Oh, is that what slower? Look at that G. Is go on.
For anyone who can't,
there we go. Put it over your face, and you might actually.
Stagflation.
Higher inflation and slower growth is the what we don't like to see. So what have treasuries done on the back of that, people? Well, you see that not only has the 30-year hit 5%, the 20-year has hit 5 as well.
Oh, sorry. Yeah, I think he was looking at me. Sorry, I was just praising my own handwriting over there. Yeah, I mean, if we look at the sort of the bonds as well and the US treasuries, it's worrying to see that the cost of borrowing is continuously increasing to be high, and this is all trickling down to a lack of, it's leading to reduced US budget spending, higher deficit. Each percent that this goes up, it's billions in interest payments. So yeah, this sort of big debt bubble that we have in the US, it's the more we continue like this, the closer we get to bursting it and finally having a complete meltdown.
So poll of the day was yesterday. The top of the S&P 500 for the year was 6,300. The highest we're going to see it. That is the poll of the day. We're already 1.2% lower. So that is producer Phil just about to put that out. So moving on, we of course had our wonderful Rachel. Only one tube. It's about, well, it's actually we're opposite this coffee shop that Angeline very kindly brought coffees in this morning for both of us.
Yes, for both of us. No, she let me drink the
Kool-Aid.
The burnt office coffee. We don't spend money on good coffee, so we can keep costs low for our clients.
Championing the client.
Exactly. Please do continue, Rich.
So Mansion House speech. This is a hangover from 2010. We saw just absolutely incredible regulations build more and more and more. And it's why I eventually left banking in the end, because honestly, the red tape. I had to sit in 2016 and spend 2 hours reviewing emails of my staff members. 2 hours reading their emails. There was some quite good gossip in there, to be honest. But
Seems like you love a bit of bureaucracy, you, Rich.
it was honestly, and that's head of trading, right? For Russia, Turkey, South Africa. Do you not think there's more important things going on in the world than a couple of my staff swearing at each other in South Africa on an email?
For you, definitely.
So yeah,
So, Rich, we put you in
regulations
charge.
got more and more and more.
We put you in charge. What do you change?
No, this is what she started on last night. Is great. Does it go far enough? I don't know, but it's a really good start. So Rachel Reeves also writing in the Financial Times today, but the summary tells the regulators to loosen up and boost share investment. So this is exactly what we are here for, Ronnie, isn't it? We're to help Rachel and help the people out there with their investing mission.
Yeah, absolutely. And I think it's sort of a growing trend to sort of cut the red tape because people realize we have gone too far. Absolutely. Prior to 2007, 2008, we didn't have enough with the constant deregulation led by Clinton and, not Ben Bernanke, Alan Greenspan's low rate.
Yeah.
But now we've sort of gone too far the other way. And I think people are realizing that we do need to find a middle ground,
Especially in this country.
Yeah.
America did away with it a long time ago.
Yeah, but
they are
UK
firing on
well.
all cylinders.
The UK as well needs to have that sort of, needs to be a bit more sort of free market friendly, in my opinion. I mean, we're looking at Switzerland and they're now imposing higher reserve capital rates, which are, harming the banks over there as well. Maybe your former Credit Suisse.
I was going to say, yeah.
Your former Credit Suisse pals would disagree, but there needs to be some sort of incentive for the financial sector to be located in London and to have that sort of growth come through, and that's through deregulation. Even though we love the FCA, let the record show.
Absolutely, and we love the path that they're now going on.
Yeah.
Because here is Rachel Reeves' article she has penned herself in the Financial Times today. Her opinion piece is that the pendulum has swung too far on risk. What does she mean by that? Well, we have literally gone too far. Risks, like most things, can be good and they can be bad. It's not good for an economy to bear too much risk, because we've seen it in the financial crisis. Assets collapsed, working families paid the price, bail out the banks. The protections that were put in place in the years that followed were the right thing to do, right? Nobody's arguing that. 2010 to 14, they really needed to put these stringent regulations around banks in particular. And the better protections for consumers as well. More accountability, such as my boss's boss would have gone to jail if I had done something wrong. To jail.
Your boss's boss.
My boss's boss.
You know what? If more people went to jail, maybe we wouldn't have the 2008 crisis. How many people?
Well, no, they should have gone to jail in 2009,
Yeah, exactly.
10. But more than a decade on, 15 years in fact, she's been a little bit low on that number. The pendulum has swung too far in the opposite direction. Excessive focus across our economy on stamping out risk entirely. And that is a UK problem. We are the absolute worst at it. Excessive focus on stamping out risk entirely. The same flawed judgment that has seen newts and bats block major infrastructure projects is the one that requires almost 140,000 finance professionals to certify they're fit for their roles on an annual basis. It's short-term thinking, it slows authorizations for innovative tech companies, and it delays their journey to growth and the access to capital. More growth, more profits, and more tax revenues for the government.
Absolutely.
So I think she's definitely made a step in the right direction there. But we'll see. No change to cash ISAs, but she is going on a education rampage. I'm sure she will probably want to sponsor this show.
Yeah, I'm sure. I think she even reached out to someone about coming on the show because she knows the influence that this show carries.
Yeah.
But yeah, I think there's a lot of sort of needs to be sort of, we need to sort of just rip the carpet out and just start over fresh in order to fuel the economy. And it starts from the bottom up, right? It starts with the grassroots, the investors, the everyday investors. I mean, if I can give a shout out to my home nation, Sweden. We have sort of uncapped investment savings accounts, and we have the world's highest highest percentage of the population that's invested in the local stock market.
Sweden does.
Yeah.
Well done.
And there needs to be a similar implementation here in the UK as well. 20k ISA allowance, great, but increase it to 30 if you put the extra 10 in UK stocks. There's trillions of
People got
pounds.
angry with that though. They actually got angry. You're giving them the choice.
They don't know what they want.
You're giving them something more. You're saying 20,000, go and invest in wherever, India, United States, Azerbaijan, who cares? That's 20,000 your ISA. We'll give you another 5, and if you choose to use it and invest in the UK, then you'll get it. And people argued that was wrong. It's like, well, don't use it then.
Yeah, don't take the free money.
Yeah. And what's happened since? Oh, well, the FTSE's gone to new highs.
You would have thought.
And that's what happens. Little bit of momentum behind this. In pound GBP terms, then the FTSE's up more than the S&P 500 is this year.
Yes, Matern is right. Norway also has the largest pension fund in the world. If I was in charge,
I'll tell you what, they are hard to trade with. Oh, they run us over. I remember they sold me 50 million euros of Volkswagen once, right? And I had about 3 hours to get out my risk before they came on and went, right, we want to sell another 50. I'm like, I've still got 40 left. You're going to shit all over my market. And literally, we held them off to the next day, but we must have taken about a 200,000 euro loss on that, I reckon.
And this was when you were at Credit Suisse?
No, this was at Macquarie.
And they were just like,
oh, they're animals.
Pumping out on you.
Yeah, they're really.
But the size they deal with, they're the world's largest shareholder. I think they own 1.5% of the global stock market or something like that.
Wow.
It's insane figures.
And I tell you what, they did a massive rotation in 2018, just when everybody was going green. So remember, like, if you hold BP, that's you're causing global warming and tobaccos, everything like that. So of course the whole ESG movement,
they've been at the
they
forefront.
were very good at that.
Yeah, let's see we all saw how that turned out.
Yeah. Anyway, we sidestep.
Yes, apologies.
Let's take a look at the futures this morning. So as we said, S&P 500, 6227, NASDAQ coming back down as well. It hit to 23,000. FTSE taking a lurch lower there. That's on the back of the pound going higher on those inflation numbers. And Bitcoin took a bit of a bath yesterday, down 3%. That's regaining some of it, up 1.5.
I mean, what's quite interesting to me, what's just pops out to me is that we see sort of oil stabilizing at around the 65 level. Mm-hmm. That's been sort of all over the shop, but I feel like now with sort of the sort of blunt instrument of Middle Eastern uncertainty, as people have sort of, we've gotten used to that level of uncertainty and headline risk. So it's sort of like, it's just blunts off. So oil keeping steady at 65, I think that's where we see it going forward. And then what else is popping out to me?
Let's take a quick look at iron ore because we have...
You'll have to educate me on this market, Rich. I'm not...
Oh, it's a tricky one, this. It is a tricky one. But everybody's looking at copper at the moment. But look at that, iron ore. So you put iron ore and coal together and you blast it at a massive heat and you get steel.
Oh, interesting.
Right, so huge component. This, this is Australia's economy.
Iron ore.
Yeah.
Well, Australia, they are. Did you? Is in Australia's? I forgot his name. Mr. Australia, I'll call him, as Trump called Japan's partner, Mr. Japan. So, Mr. Australia, he was meeting with the Chinese leadership now. So it's interesting to see how they're going to come out from this meeting, because it's their biggest trade partner, but it's also their biggest national security threat.
Yeah, and they've, in the end game, they've got to decide who to go with.
Yeah.
However, look at Rio Tinto. So that was my point there. Rio Tinto has most definitely recently underperformed iron ore. You've seen a nice tick up, remembering that 70% of Rio's revenues are from ore, dropping down from £45 yesterday, £43.46. That's important because we had a mining theme this week. John Mayer, really good interview the other day. And he believes that copper assets are the most desired. Now, Rio's has got a bit of copper. That's, I guess, 10 to 15% of its revenues on top of the 72% of iron ore.
Why is copper the most desirable one?
This continued idea that you need so much of it to go into data centers, to go into EV, and there is or has been a continual lack of investment into new mines and new future production. So you've got demand going higher, and you've got the future supply. Not at the moment. At the moment, it's still balanced, but you're going to have a deficit in the future, and a small deficit, this thing moves. So that's the iron ore price, that's the copper price, and the mining sector is starting to look interesting because it has been left behind, really, with the FTSE. It's been left behind with the tech sector, for example. But why am I talking about this? Well, because if we're going back into an inflation trade, then the materials are somewhere that you definitely want to be looking to have exposure.
Now, should one buy, in your many years of experience?
Too many to mention.
About 40 years you've been working? Is it 50 years you've been working?
I got my first stock 29 years ago.
Bloody hell, mate. Yeah, wisdom right here. So in those 30 odd years of wisdom, would you say that as a trader who's looking to sort of inflation hedge now, is it better to buy a Glencore, a Rio Tinto, Antofagasta, or should I just buy directly the underlying future of the commodity?
It's tricky. It depends on the supply setup, right? Because the trade back in 2006 was you buy anything the Chinese don't have, right? Because they were obviously the big consumers.
Yeah.
But stuff like aluminium, they already had bundles of it, so there was no demand, and aluminium just was useless. So if it's a stock that has exposure to something that is in short supply, that's what you want to go for, because the stock gives you the extra leverage. But if it's a crap company,
yeah,
then you don't want to touch it. And that was the South African gold miners, in fact, most companies in South Africa, because of the cost overruns.
Let the record show.
Most companies in South Africa,
let the record show,
are terribly run, and they don't have.
Is this what it usually
energy.
feels like for you when I sit here and say crazy stuff?
I don't think there's anything crazy about South African stocks have been a massive underperformer in the mining sector because of their operational problems.
Rich's questionable comments aside, which mining companies has the most exposure to sort of copper or any other commodity that is undersupplied?
What are you looking for? So this was the play of the week, that Anglo-American has the problems in South Africa, therefore is trying to sell its South African operations and de-merge from them because it's holding them back.
Yeah.
Right? So Anglo's wants to become a cleaner copper play, and therefore will go back into the shop window because it has some really top quality copper assets.
So Anglo is the one I should be looking at.
Well, Anglo's is the one that our expert said on Monday that could be a bid target in the future once they do the cleanup. So it's a kind of longer term thing. But yes, I bought some straight away.
Thank you, Rich. I'll now conduct my own research, which I can do on the IG platform.
But the sector in whole is interesting. You know, Rio's has been a big underperformer, but that's because the CEO departed in very strange ways. Right, it is now 7:56 a.m. We're going to take a 1 minute interlude for you to guess the chart. Now, I got it yesterday, so are you going to beat me? That's an incentive just to shut me up. Get in there and get your answer up. It is a UK stock. Who is going to be fastest finger first on the comments? Are you ready? Albanese.
Yeah, thanks for that, fire truck.
3, 2. You beat me. Well done, Gavin Ackers. Well done, Julian. But yeah, Gavin was first with Kingies. Boise, that's funny. I said, is it Legals as well? But it's a bit too high for Legals. And Legals didn't have that big run up last year. Kingfisher, B&Q. It's also got a French business as well. I don't imagine you've ever done DIY in your life, have you?
That's not for me. None of that nonsense. None of that woke stuff.
IKEA.
I build IKEA furniture. That's about it.
Okay.
Yeah. I'm a handyman when it comes to IKEA. We have, like, in school, we learn how to build IKEA furniture.
Right. Today, we've actually had news from Antofagasta. They have maintained their full-year copper production forecast. They see a positive outlook over the medium term. They are looking up 1% in your fags. AstraZeneca, unchanged. They've had an update on some drugs. Bloomsbury up 2%, Workspace down 2%, and ASML. We had ASML numbers. Just a really quick. Do you want to cover those?
Yes, they did beat expectations with Q2 bookings at 5.54 billion euros against expected 4.8 billion. However, the concern comes from not. The concern comes from the lack of guidance coming forward. In my opinion, I think ASML is I was speaking to my friend who works at BlackRock as a tech equity researcher, and says, if you love your grandparents, sorry, not grandparents, grandkids, buy ASML.
Right, Marks and Spencer's, they're down 60 basis points from the off. That's as low as I remember seeing Marky's for a while. So that's interesting. It's definitely been an underperformer since the cyber attack.
If you like them up there, you love them down there.
Not so sure. What else do you see there, Ronnie?
There's nothing that's really sort of popping up. So
On the downside?
yeah, nothing crazy interesting.
Let's go upside then. Where is it? It's Hammerson, recovering from bit of weakness yesterday. HSBC up 1. And
That is up slightly, 0.5%. HSBC.
BAT's up again. My goodness, that thing is strong every day.
And that's a good dividend stock as well. Are they dividend aristocrats? Or dividend
yeah,
king?
I cannot remember them ever cutting a dividend. So yeah. Oh, right. Let's go across to Europe because producer Phil is telling us ASML is down 5.5%. Luke Moore trying to buy it yesterday just because Nvidia was up. Well, you've got some problems this morning if you've done that because you are 5.8% worse off. Luke Moore buying it at 700 euros yesterday. Tricky because Nvidia had some positive news.
The thing is, with ASML, I don't think you buy ASML for the sort of short term. I think ASML is an interesting company because one thing that we have to remember is that ASML is the sort of, they produce the machinery that these ultra laser scanners that create the chips. Yeah, I did science in school. And
Did you? School, not university.
no, definitely not. But we have, with the competitors of Nvidia entering the chip manufacturing or designing market, so Amazon are designing their own, Meta, Apple, and Alphabet as well. There's gonna be a larger group of companies who are buying these machines and the need of them.
But it's a continual underperformer. So there's clearly a problem. I think we have to ask Piers. Piers is on tomorrow. We'll ask him about ASML because this thing is just an absolute dog in a sector that's at all-time highs. Another dog, a French one, Renault. Having a profit warning this morning that read
the CEO as well.
About blooming time. Because, I mean, the problem is, right, they've got China, they've said the increased, do we not have a soundbite for that? Go on then. Can't find it.
They have one job.
Can't find his China.
They've got one job.
China.
There we
Yes. Wow. He's a hot in the buttons this morning, isn't he?
go. Yeah.
Thanks, Cam. Yes, so you've got increased competition from China, and you've got a terrible car.
Yeah.
So you've got no hope because you can't even compete with Ford. You can't compete with Fiat. So how are you going to compete with some great Chinese car that comes in?
If you can't compete on, and like the Nissan Leaf is expensive, like you can't compete on price, you can't compete on quality. What do you have in beyond legacy? Oh, it's suspended. Blimey, this is not going to be nice.
That's not going to be a nice open, is it?
That's not going to be a nice opening. It's time to bring Carlos Ghosn back.
What's your best guess? Because we haven't got any indication. We haven't seen anything. I'm going to guess down 12.
Yeah, more than minus 10. More than minus 10 for sure.
There was support at 38.
I think we're blowing past that, mate.
Yeah.
Yeah.
All right. So if it opens at 38.80, are we shorting it?
Yes. Just jump on the trend, mate. Just jump on. Trend is your friend.
Yesterday we had a great chance. Yesterday was buying BME, as Andrew McKelvey said in the chat. Oh, he benefited from that because BME rallied throughout the day. Let's take a quick look at what it did. That's B&M I'm talking about. Sorry, of course. We had. Where's the minute chart?
Oh, that's.
It's back down this morning. Look at that. It got as high as 241. Remember, we were talking about it 223 on the open yesterday, now trading 230, but you could have got out at 240 yesterday. Andrew McKelvey, did you sell some of the extra stock you bought yesterday?
Or did you get greedy?
The other one we saw was Bharat. That wasn't so good. That also had a proper rally during the day up to 390, but FTSE's been really ugly since it hit 9,000 actually.
Yeah, the home builders in particular had a really rough day yesterday.
Shut off.
DR Horton as well, Pulte Group. But yeah, I'm wondering if it's more than just a take profit that's coming to play here. Okay, what do we have?
Right, down through 660 euros ASML now. We saw it throughout the tech sector yesterday. Nvidia opened at 172.5 US dollars, but it couldn't hold it. The whole market could not hold it yesterday. You had Marvel, the technologies, that is a play that we're watching here. That was up 2.5% pre-market. Got down to only up 60 basis points. They did not like seeing the 23,000 NASDAQ and the 6,300 on the S&P. Europe continuing to get hit this morning. We're seeing a lot of retracement, even through new lows for stocks like Porsche.
I'm genuinely concerned with the European automakers. I mean, because they can't compete with quality anymore. That used to be the thing, right? They used to be, yeah, you can buy a cheap Chinese car, but you'll get a much, much better quality from us. Pay for the premium.
Sorry, who's us?
European car makers.
Us and them. Apparently BYDs are real top quality.
No, what I'm saying was this was before.
Ah, got you, right.
Yeah, maybe if you paid attention, you'd understand.
Back in the good old days.
The European car makers would always be superior in
Not
quality.
The French. What are you talking about? The German ones,
Germans,
yes.
the Germans.
Well, don't talk about Europe.
Okay, the German.
Sweden and Germany.
Sweden and Germany. We don't have any cars anymore. It's owned by the Chinese now.
Oh, really?
Yeah, Geely owned Volvo.
Oh, no.
Yeah,
you
and
sold out your prize asset.
Yeah, that was ages ago. Anyhow, back in the day, the Germans could compete with quality. Now, as we've done the shift towards EVs, they can't compete on quality, nor can they compete on price.
And they can't spend the amount needed to keep up.
No, exactly. And they have bloated corporate structures that have built up through legacies. They don't have lean organizations like the Chinese do. And they don't have the state backing as the Chinese companies do.
What I'm hearing from you is, let's see a merger of Mercedes-Benz and Porsche, or BMW and Porsche. Mercedes-Benz and BMW would never. They would rather. Or Volkswagen and BMW, or Volkswagen and Mercedes-Benz.
BMW merging with Volkswagen. Isn't Volkswagen like 50 times bigger than BMW?
No, not anymore, because it siphoned off Porsche, remember?
Right. I would rather see Volkswagen and Mercedes coming together and creating like a powerhouse of the ultimate German engineering car.
That would be incredible, wouldn't it?
Yeah.
Absolutely incredible. And it needs something like that, because these European manufacturers, they've been terrible for years.
Yeah.
And the margins are not great.
No, because they continue to. I mean, they have strong. So especially Volkswagen. If you look at Volkswagen, they got the Lower Saxony, who's owning 20% of the company, basically ruling it. Companies ran by the labor union. You can't run a business in that sense, and you have the Chinese who are coming in, extremely sufficient, extremely quick. I mean, yeah, get used to this. It's just going to be a continuous cutting of outlook because it's not looking good.
Look at that operating margin. How embarrassing is a 6.5% operating margin? Your leverage on revenues is just, you see slowing revenues and you are toast.
Yeah, I mean, this is horrendous return on capital.
So aiming to achieve full year free cash flow of 1 to 1.5 billion versus 2 billion euros previously announced. They're cutting their free cash flow target by as much as 50%. Whoa, this stock is toast.
You know what? I want to give out a special thought and prayer to our old friend, producer Fred.
Yes.
But producer Fred was smart enough to buy Swedish. He owned a Volvo back when it was Swedish.
Is it really? So what does this mean then? This mean it's the stock suspended?
Well, is on the exchange, if it more than -5%, they're gonna halt it. So it's probably halted by.
Past 8 though.
Yeah, but this is probably dropping. I think we're going past 35.
Can you message the desk and see if there's any indication, please? Right, let's keep an eye on Renault. Producer Phil's going to have it up on his screen as well. But what are the others? Well, Stellantis is seeing through some of that read-through. Stellantis, of course, has the old Peugeot involved in that. That's down 4.3. And Volkswagen down 1.8. Far superior cars. Where's Volkswagen now on the chart? Because, as you say, such a better company. But if you've had money in these I mean, look at that.
Hey,
that's value destruction.
And that's, keep in mind, when's that peak? 2021?
I tell you where this is lower.
Oh.
This is now lower than where they got caught for the emissions.
Ladies and gentlemen, we just got in from our colleague Neil Ray on the institutional desk. Renault indicating down 16.5%, 34.5.
That's a great shout by you. That's very impressive, Ronnie. For somebody that's only been doing this job for about 4 months, that is...
That's not true.
Right. Yeah, between 16 and 19%. But people, honestly, Volkswagen, when the day that it was announced that Volkswagen had been in Dieselgate for years and they had been falsifying their emissions.
Sorry, yeah, I interrupted you. Was that the peak? Was that was that post the Jetta Volkswagen emission, the peak up there?
That was 2015.
Yeah, so it's way earlier, right? So
Yeah,
this was even before the peak of the emissions.
But what I'm saying now is that it was at trading at 125 euros that day, and we smashed it down to 105. And I was still shorting it at 105, thinking this thing's going through 100. And I think it touched 100 and went back up. So where are we? Yeah, there it is. 2015 bottomed at 87. Sorry, on that day. And
so that was a good shot from you then, saying that it's going to go past.
I think it was there for about 10 minutes though, because I remember not doing particularly well from that trade. But it is now down at the same level as it was. Yeah, there we go. Oh, it was even higher than I thought it was. It was 145. And it was a couple of weeks later, it dropped to 100. But yeah, it wasn't there for long and straight back up. We all got caught on that short.
Yeah, I'm not very positive on Volkswagen. I don't see any sort of turnaround plan. Their car is more expensive.
But there has to be something to do. Got to be. Right, Renault's open.
Renault's open. Cam's fucking... Oh, sorry. Go on. Sorry.
I think maybe drop a little apology in there.
Sorry, guys. Sorry. It's going mental in my ears. Sorry.
Too much excitement.
Too much excitement here.
This is why we don't give Ronnie coffee in the morning.
I had a Red Bull as well.
It's that early morning gym session, isn't it? So, yes. Ronnie clearly long this in the demo account. He's getting all emotional about it. But 35 euros. What do you do? What do you do? We said it's broken that 38. Obviously, clearly, a lot of people short this and they buy back straight away, right? So all the smart people, I know my good friend Nihao that has been doing this for 15 years. He's the kind of guy that's going to know that this was coming because he works so hard on it. I'm sure he's in there, right, buy me $5 million on my short. Thank you very much. I've made 600,000, 700,000 today. I'm done. Done for the day.
That is going,
But once those people have closed, then you get long funds coming in to sell it all over the day, don't you?
Yeah.
Potentially. In some situations, it may not be this one.
Oh, look at the gap on that, mate.
So, oh dear. Where does that settle? This is when valuation comes into it. Forget your technical analysis. This is when you need to know how much of the stock was dependent on that free cash flow that they have now cut. We take midpoint, 33%. This stock could be down 30% today. Like there's real concerns. There has to be concerns about the longevity without some serious changing of the business model there. If the Chinese are coming in with serious competition, then how does something like a Renault keep up?
The thing is, we obviously talked about merging some of these companies, right, to become a bit more competitive, merging what a Renault and a Stellantis, but I'm not sure that will actually be positive for them because these companies already have bloated structures, they have bloated human capital, and I think merging them together will just make it even more of that. There just needs to be significant cuts in terms of spending and significant improvements in terms of research and development, and it's sort of like you need to spend way less on your operations, but you also need to spend way more on your research and development to actually be close to competitive, because the Chinese are leading the EV race.
And they don't have the cash generation to do it.
That's the thing.
Yeah.
That's the thing. They're stuck. Just close down shop, guys. Just close down shop. There's no coming back from this one.
Give the money back to
Give the money back to the shareholders. Seriously, strip off the assets.
See, if the long funds come in to sell this today, and I do not know. I haven't looked at Renault for months, right? But all I'm talking about is experience in the autos on a profit warning. If a serious seller of this, and I'm talking about somebody who owns 1% of the company, wants out and they make the decision in the morning meeting, I don't know how, as I say, it could be down 30%.
Easily. And it's, this might not even be the worst of the news. They have a new CEO coming in. He's going to have to reassess the situation. Mm-hmm. I mean, he's I think he was I'm not sure if he was in the company before, but yeah, I don't think I can't see any sort of positive catalyst in the company.
Yeah.
They're not even best in Europe. They're not even best in France.
Right, so we've got that was a nice little story this morning. But let's not forget ASML now down 7% in ASML. Stellantis down 3.8, and our UK friends not having the best of mornings either. AstraZeneca. There was talk overnight of more more tariffs for pharmaceuticals because.
Yeah, Trump has announced that he gave, what did he say? Here we go. We got Trump's comment up here.
And just before we move away from France, do you know what the Prime Minister suggested yesterday to help the French economy? Huge cuts in public spending.
Yeah.
But they're going to cancel 2 of their public holidays. That is what the Prime Minister is suggesting.
Oh, what? I just know. Yeah, they're gonna cancel the public holidays. How much you want to bet the yellow vests are coming out? The Peugeots are being burned. The offices of LVMH is getting smashed.
You can't cancel public holidays. Come on.
In France as well. There's nothing the French love like their time off.
Allegedly. Do we have anybody French in this company? Or
yeah, we got Maxime at the We got Maxim in the on the desk. I texted him as soon as I saw the news. I texted him, and he told me, "Yeah, already arranging the riot." Just kidding. He's not gonna riot.
Do you have Bastille Day and things like that against? Right, number of public holidays in France is 11. Oh, there's minimum and maximum though. Minimum, maximum. In Germany, it's 10. So Germans only have one less than France. I'm surprised by that. So you don't want to cancel 2 of them. And the United Kingdom has 8.
Maybe we need to cut a couple of them to get our growth going.
And maybe we increase by 1. Give everybody... well, no, I'm not going to go there. God bless the Queen. We had an extra one then, didn't we? Right. On that, we'll go to break.
Okay, guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat. Come on. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money just sat in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest. And it's days like this, we get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically, in investing that you can from cash. And that's not saying people go out and take a load of risk. It's about education, and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash.
Hey, trader friends! Welcome back to the show with Ronnie Eggnog here this morning, talking all about Renault and loads of other things that will not be. Lots of you on the chat here loving this morning. Nothing like a profit warning to stir things up. We've got the poll results out as well. Take us through them, Ronnie.
I don't even remember what the poll was for, but
we just seen the yearly top for the S&P 500.
45% says no, we are going higher still. I hope so, because my pension is very heavily invested in that. Yes, I believe so, says 33%, and only time will tell, which is 10% and the most boring answer. And then we will stay around this level, says 9%.
Wow.
What do you think, Ange?
I did vote because, as you know, I'm out there giving all our trader friends, you know, the sort of filtration of the Ange AI that I'm building at the moment to try and give them the upgrades and downgrades ahead of the game. Also the biggest movers of the morning. So I hope you guys appreciate that. I think it will continue to move higher. And on the premise that, you know, we don't have a huge number of shocks from Trump, but markets don't seem to care anymore. You know, they don't seem to. We've been in this place so often with the taco that they don't seem to care, and the melt up seems to be grinding higher. Taking a look at the indices here, trader friends. I'm just giving you a quick check in. And currently, as we count down to the all sessions, it looks like a pretty flat to slightly lower day as well. Going through some of the movers, let's just quickly, we're looking at Renault earlier on, let's just quickly see how far it is. Now starting to head deeper into the red. It's now almost 17%. So earlier, remember I was saying ahead of before it uncrossed, I said early indications suggesting 16% down. It is now almost 17% down as we speak. I hope someone's told Fred about this, because he drives a Renault, doesn't he? A Volvo.
Oh no, Fred, he's a Volvo. He's
man.
a Volvo. That's how me and him became friends. We bonded over a love for Volvo.
Do you remember the ad? I think it was a parody. Don't go sexy, go boxy.
I don't remember that.
Buy a Volvo. Let's have a look elsewhere. If you take a look at ASML, going to bring that up for you as well. ASML, one of the biggest losers in Europe. Look at that gap down there. This is the hourly chart for you trader friends. What is it you always say on the show? Something about if you care about your, is it grandkids? Is it ASML?
Yeah. If you love your grandchildren, buy ASML. It looks like now you hate your grandkids if you buy ASML. I'm not quite sure I can hold on to that, but I'm still a firm believer in the company. I think they're part of the sticks and shovels of the AI race and development. I think if they can just get their darn guidance in order, I feel like they can never get their guidance right. They always like. Who's in that financial planning and analysis department? Because they need to switch that out, because the guidance is always wrong.
It is always wrong, isn't it? So in this particular case here, with the reason for that big gap down is that ASML said that they would not or may not achieve growth in 2026. Yeah, who's dealing with the projections there?
Yeah, but they did achieve growth in 2025.
Yes, and this is even after, that's correct, after second quarter bookings beat the street.
Yeah.
So there's a bit of a disconnect over there. This is, of course, the gear maker, the world's biggest supplier of the stuff that makes the chips, that makes things work for us. This move also coming after Trump's most recent tariff statements, which is creating a huge amount of uncertainty. The EU also looking to potentially hit back. So all this not great for that industry. Let's take a look elsewhere. Some of the other movers today that I highlighted earlier as well. So bring up my filter there. We are seeing pretty much a down day for some other names there. Bring up Hayes. Hayes, yeah, down 2.7% there. This is the hourly chart there, trader friends, but showing you the 1 minute rather. There you go. That's better. Here is Hayes.
That's a recruitment firm.
Yes, and things are very, very difficult for this market. As was it Monkey Man or was it Gavin Ackers that said this morning something about loads of people out there who don't know their jobs, don't want to hire people who actually know what they're doing because it makes them look bad. But also this move is because of a broker rating cut. Morgan Stanley slashing Hayes from equal weight to underweight, and also the target price that they're looking at now, 55 pence. It's currently at that 65 handle as we speak, 65 and a half there.
Ange, what's your view on the pharma stocks with Trump coming out saying that pharma tariffs are expected probably at month's end? Because they haven't moved much today. We saw AstraZeneca down about 1%, but nothing that sort of screams scared or anything like that.
Yeah, so AstraZeneca is indeed lower, 1.3% there. But I think it's going to be trade the fact, right?
Yeah.
So a lot of this has been baked in since October, trader friends. So those of you that have been watching since then will remember me saying that even since last autumn, Trump had already been saying that the crosshairs will be on pharma. He's already made no secret he wants drug prices to be cheaper for all those voluptuous people over there.
Yes, and in putting tariffs on will definitely decrease the price.
Well, it's not gonna. It's gonna increase the price, but also he's gonna do that thing, the art of the deal, and he'll say, "Well, if you want me to take these tariffs off, then you're going to have to lower your prices and allow us to bring on cheaper versions of whatever you're selling are not very well Americans." Yes.
Well, yeah, and also it'll be a bit of a fierce competition with India, who's investing heavily in becoming the sort of pharmacy of the world, with sort of acquiring a lot of pharma production capacity. So I'll be watching the pharma stocks quite closely to see what the development is.
I think trader friends, if you're trading in space, be very careful, because we could see, a huge move if we suddenly see tariffs come through on that. However, until it's almost like trade the fact. Incidentally, India is the biggest producer of paracetamol. Yeah, and it has, I would also hasten to add, solidified its position as the world's biggest maker of generic drugs as well. But AstraZeneca, that moved lower today, also to do with the fact that its amyloidosis treatment managed to fail the main goal in a late study. So that is one of the reasons for this big move lower. Right, I hear lots of people asking for NVIDIA. Rich McDonald coming in on the chat as well. Chinese production lines versus French. I wonder which I back, considering a woman in China has been arrested for trying to hold the train door open for a friend over there. Interesting, I did not hear about this.
Rich is getting arrested by the CCP as soon as he lands.
Okay, we only have 2 minutes to go. So trader friends, any questions for Ronnie and myself? We will look it up for you and video very quickly, because of course this quietly rose to a 4 trillion stock. Is that right? 4 trillion, I hear?
First ever company to reach $4 trillion valuation.
Yeah, come on. We are going to be looking at this ahead of the all sessions here. This is the daily chart. Very strong uptrend still in play there. NVIDIA coming out with lots and lots of comments already, saying that Jensen Huang saying US will be vibrant, China will be dynamic and continue to grow. There is always room in any house for 2 people, which is what I'm expecting him to say a lot later, as well as he makes his tour around Beijing, because he's talking in Beijing.
He's meeting the Chinese premier, right?
Yes, I believe so. And he is also expected to outline the software and capabilities of China a bit later on. Because obviously the thing with NVIDIA that everyone needs to remember is it is in their best interests. Trader friends, you're listening here, this is very important. It is in their best interest, NVIDIA's best interest, to continue supplying chips at a competitive price to China, so that China doesn't develop their own competing chips. Yes, and the other thing about NVIDIA as well is, you like all your tech. Ronnie, how much tech have you got at home?
Quite a bit.
Are you one of those that talks to all your tech in every room?
No. I try to.
And you have a Roomba going around the house.
I try to keep it analog, but I am. One thing about NVIDIA is that they've now sort of come up with tariff safe or sanction safe chip that they can sell to China, which is important for them because that is roughly 17% of their revenue. So being able to continue selling to China is vital for the development of the company.
Okay, great. Well, we have not much time left, so we have to leave it there. Pelican, good morning to you. And Rafi as well. We have Axel waiting the wings, so we are going to have to love you and leave you, but don't go, because Axel is going to be charting crypto up next.
Oh.
do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns, that's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Bring me the next shiny new thing. Bring me the next shiny new thing.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees, with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
Hello and welcome to Charting Crypto. Let's start off with Bitcoin. And if you remember last week, we talked about breakouts to the upside happening in a lot of cryptocurrencies, and Bitcoin hit a new all-time high. And more importantly, it hit my 161.8 Fibonacci extension target that we discussed as well. So let's go back to that and see how we can use Fibonacci extensions in order to do our analysis and see where markets, when they're making all-time highs, can get to from a technical perspective. So to do that, I'll go back onto my monthly chart. And you may remember from last week, I went through how to do a Fibonacci extension. Let me just make this RSI here at the bottom smaller. But basically what we did, can you see this line here, the horizontal line? Basically what we did is we took the distance from this low here, from the February 2019 low, all the way up to the highest point of that uptrend, which took us to the high seen in October of 2021. And then we projected that distance from down there to up there. We multiplied that by 161.8, 1.618, and then we projected that multiplication number from the low of that correction of that previous uptrend. So basically you have an uptrend, you take the corrective low, you multiply the distance of that uptrend by 1, 1.618, 2.618 and so forth, and you get these Fibonacci extension targets in the future at some stage. And basically when we projected this from down there, we ended up with this target up here. Now, on TradingView, can't exactly put it on there. So I actually worked it out mathematically, and I ended up with, I think it was 122,023 or something like that. And this is exactly where Bitcoin went to this week. Now, it's not an exact number. I mean, it's never going to be to the point, but it is close enough. And quite often, when these Fibonacci extension targets get hit, the market then also corrects short term at least. And this is what we've seen so far. So can you see here on the monthly chart, we went all the way up to our target. Let's now zoom in onto our daily chart and see what happens since. And you can see that horizontal line is the 161.8 Fibonacci extension target that I just showed you. and we hit that on Monday, the 14th of July. We actually went above there. We went to $123,811. If I remember correctly, that's right. That was the all-time high in Bitcoin. And then, lo and behold, as I just said, quite often around the Fibonacci extension target, you get a short-term retracement. This is what happened yesterday. And we've now fallen through this accelerated uptrend line, this dotted line here. And we went back down again to around 115,739. Now, the question is, since we've hit this upside target, is that the end of the current uptrend in Bitcoin? Well, not necessarily. It could go higher still. And technically speaking, since we've broken above these previous highs, one going back to May and the other ones going back to January and December, we are still in an uptrend. We have what I showed you last week, had this A, B, C, LUF correction, this zigzag correction, which I like to look at as well. And we basically then followed that with a breakout above these highs, and that was bullish, taking us to that upside target, which is why last week I said to you we could head to that target perhaps if we continue with this upside momentum. Now, we've come off this all-time record high. That in itself doesn't mean anything. I mean, look, here we've come off that all-time record high, and then we tried to retest it, and then the retest failed, and then we came down again. So if we see something similar happening here, so a move up today, maybe the day after tomorrow, and so forth, and then we have another leg where we do turn down, then short term, in that case, we may have a minor top. But it might just be a minor chop in a long-term uptrend. And you can see the same here. Can you see we went up, came down, then had a retest, failed below that low, and then came down here. So at this stage, you knew that likelihood was that we would actually retest that low, which is what we did here. But we haven't seen that yet here. So basically what I'm saying is, as long as we stay above yesterday's low, which was at 15,739, you're still bullish. We could still make a new all-time record high. If we were to have a retest of that high and fail, either just slightly above it or slightly below it, and then reverse like we had on these candles here or there, then perhaps, or here, we could see a correction, but only then. So don't anticipate anything happening. Just wait for the market to tell you what is actually going on. Now, from a medium-term perspective, if you look at the trend of Bitcoin, it's clearly bullish. As you can see, a series of higher highs, higher lows. We had this corrective phase here between May and June, and that was the last reaction low of this ABC correction. So if we were to fall through that low on a medium-term perspective, then perhaps we have a top in place with regards to Bitcoin and could see more consolidation. And that low was made at $98,330. So basically, as long as we stay above there, everything's still bullish with regards to the medium-term uptrend with regards to Bitcoin. So if you have any other questions on Bitcoin, let me know. I've got a question from someone about XRP. Let's look at that. And let's see whether we see something similar. Now, we may remember last week, we talked about, when was last week? Monday, the 7th of July. And basically, you can see here, we talked about this resistance area, didn't we? So let's imagine we didn't know what was going on, but so that we were here. We were just testing this area, if you remember. And I put on here resistance, support. I said we were trading sideways. And if we were to break out above that resistance area. Now, why is that a resistance area? Again, let's look at our basic technical analysis, but it can be so powerful. What you do, you take a series of previous highs, even if data has gone through there, and previous lows. And you can see these highs here on the daily chart. We had several highs here, and these highs, and these highs, and these highs. In this case, we didn't really have any lows except this one here on the 11th of May. But that whole cluster of data was our resistance area. And you can see it held its resistance again here on the 30th of June. And then we tested it on that Monday when we discussed XRP last week. And that was also where the red line was, the 200-day simply moving average. So we had a lot of resistance coming in there, and that was capping the upside. But what we also saw is that the corrective move to the downside might have ended on the 22nd of June, and that since then we've had a series of higher highs and higher lows. And then lo and behold, on the next day we came off that resistance area, but on the following day, on Wednesday, we broke through that resistance area above the 200-day simple moving average and closed above that resistance area. And that was bullish. So basically, that bullish move then told us, okay, what's the next likely scenario? Well, since we've broken out through that resistance, the upside targets we had before to the left of your chart are the next target. So the 23rd of May high, that for XRP was at $2.48. And then the next higher one was the May high here at $2.65. And what happened? Within a very short space of time, we went up here and through these levels to the upside. Now, what's the next target? How do we know? Well, basically what we do, we go and zoom out. You can see we had this high here and that high here. Can you see how we got close to that high which we made in March of this year, here on the 11th of July, then failed, came down again, and then retested that high. So what are we seeing now? We are seeing a slightly higher high. So we've traded at levels last seen in February with regards to XRP. And the question from the viewer was, oh, that's actually on Bitcoin. So I'll cover that in a minute. Sorry about that. But on XRP, what can we see now? So we're trading at levels last seen, as I said, in February. What's our next technical upside target? So you go further to the left and you go, okay, it might be this high here from the 30th of January and then these highs here. Right, so that is the scenario at the moment. What would change our scenario? Well, basically, we can see we have a series of higher highs and higher lows. And basically, we are still heading higher despite that drop we saw yesterday. So as long as we stay above there, the trend is very healthy and we're still going up. Now, if we were to fall through yesterday's low, what might happen on a short-term basis is that we could retrace slightly lower. But are we seeing any negative divergence on our oscillator? Can you see down here the relative strength index? No, because we are seeing a higher high. This high was accompanying this high, and this high here was accompanying this high. So we've got higher highs on the price chart and higher highs on the relative strength index. And yes, it's overbought, but it can stay overbought longer than we can stay short. So don't read too much into that. If there was divergence, if we were to see divergence on here, then maybe I'd be a bit more reticent. We're not. We're seeing higher highs. So basically, the trend's your friend. As long as we stay above yesterday's low here at 280.52, we remain bullish on XRP. Now, if we were to fall through that low, we could see a minor correction. Do we have support somewhere around there? And can you see that low, by the way, was made around these highs that we made back in February? And that's why you look at previous highs, which can act because of inverse polarity as support going forward. And if we were to fall through that support area, where's our next support area? Well, we've got this high here from the 20th February high. That was made around 275. And then we've got this really important one here before the corrective move. And that was the May high, and that was around 265. But that's a long way away. So basically, if we were to consolidate, it's likely that we're going to stay above that high here. And if we were to come down, that high with all these highs here would probably act as support. So basically what I'm saying is, unless we have a major sharp reversal to the downside, which currently looks unlikely, the odds are that further upside is happening at the moment and may happen in the near future as well with regards to XRP. Now, the question on Bitcoin was, could we see a weekly reversal here? Well, don't read things into your chart is all I can say. Let's go onto the weekly chart and let's see what we're seeing at the moment. So at the moment, what we're seeing is this doji. And the doji, as we know, is basically where we open, in this case on the weekly basis at a certain level, make a high, make a low, and then more or less close the week around the same level. And that tells you there's indecision in the market. And it can lead to a top forming if the next week is then a negative week, which falls below the doji low. So what I'm saying is, if next week we were to close below this low here, then perhaps we could see a top forming here, but only then. And the danger with saying what I've just said is that we are looking at the weekly candle as if it's closed. The week hasn't ended yet. We have to look at a Friday close, and I know that Bitcoin trades 24 hours, Saturdays and Sundays as well. So where's your weekly close? So you need to look at your chart software And usually it's a New York close in the US at 5 p.m., I believe, for currencies. For Bitcoin, to be quite honest, I don't even know. But because we're looking at it versus the US dollar, and Bitcoin is priced on this chart in terms of US dollar, I would use the 5 p.m. New York close there, so on Friday. So if then we have this chart pattern, then we can read things into that. But this chart pattern could turn into something like that, or something like this, or this, or this. So you don't know that. So basically, don't read anything into your chart, into your candle, and that doesn't apply just for cryptocurrencies, but for any markets, because these might change. So once this candle has closed, then you can analyze it, not beforehand. So just be very careful of that, because it's very easy to think, oh, this might happen, and this will happen, and this could happen, and so forth. And now, you see, talking about things happening, we've got a fire alarm. So that's funny. We'll see whether it's going to stop or not. I hope you can still hear me, because they're investigating an alarm. We had something like that last week as well, but luckily I wasn't live on the show. But let's continue the show. Let's look at Doge. And pardon? All good? Yeah, I'll carry on. I've just been told to carry on. I won't burn to death. Doge. Let's look at Doge. That's a new one. Thank you, actually. And let's see whether you can still hear me, because I can't hear the gallery, guys. Sorry. If you want to, Phil, what did he say? Keep going. Okay. So basically, Doge. Okay. We haven't analyzed Doge yet. So what do? As we know, we go back to the longest time frame possible. So here we go into the monthly chart, and we can basically see that we've had a lot of volatility back in February or May of 2021, when the all-time high was made. Then we've come off again. Then we had this support area here. Then we went higher, and then we came down again from the November 2024 high. And then we basically had this support line here. Can you see this orange line is the 55-month simple moving average? I personally use the 55, not the 50, what a lot of other people do, because the 55 is a Fibonacci number. So for me, that's a possible support area. So that held here, but it's a derivative of the price. So therefore, the price itself is more important. So what does the price itself say? Well, let's look at basically the support line on here. And we can see it's actually an uptrend line, right? So let me just change that to a solid line, because what we can see is 3 touching points. Can you see this touching point in August, September? We have another one in April, and then we had another one in June of this year. So 4 touching points. So it's a definite uptrend line on the long-term chart. So if we then go onto the daily chart, what we can see here is that we basically, with TradingView, need to just redraw it, because you want to make sure no data goes through it. And it's not that precise on the monthly chart. But we can see that we bounced off that low here, and we fell in 5 waves in Elliott wave terms. So 1, 2, 3, 4, 5. What we could perhaps see now is an ABC correction to the upside, and then another move down, but we don't know. And any wave is quite complicated anyway, so let's ignore it for the time being. But what have we seen since the 23rd of June or 22nd of June low? Well, basically, we've seen a series of higher highs and higher lows. So Doge is looking more interesting from a short-term perspective, and could actually be heading up again. So what do I do now? So I draw in my resistance line. So in this case here, what I need to do is basically do this, a dotted line. And the alarm has changed, so I hope you can still hear this one. But, well, I hope you can't hear it, but I can hear it. But apparently I need to leave the building immediately, so I'll wait for the gallery to tell me. But anyway, we've got this resistance line here, only 2 touching points. And what I do now is to draw in another resistance line. But can you see here, we've got 3 touching points, 1, 2, 3. So I've just been told to evacuate the building, but you can see here resistance, and I'll just finish off very quickly because we might burn to death here. Basically, as long as we stay below the high seen on the 11th of July, we could come off with Doge. If we break above there, we could go higher, but then your stop loss would be below yesterday's low, because that's the last reaction low. So on that note, I leave you because I have to leave, sorry. And I won't see you next week or the week after, because I'm off on holiday. See you when I come back. Bye.
Let's do this. Hello, Pat Cat. So guys, I've always been known to be the fastest, fittest, mentally the toughest, but the cash returns, that's something else. Watch and learn.
The inflation report wasn't as bad as people expected, or was it? It's Tuesday, July 15th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Elisa Bebek's in San Francisco, Dylan Radigan's in Milan, here to take you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're on the website, tastylive.com, the platform Tasty Trade, welcome. Thanks for tuning in. If you're on YouTube, thanks for joining the conversation. Tell us what you think of this action today. The pop higher overnight, thanks to NVIDIA being allowed to sell their top-of-the-line chips to China. Okay, I guess the export controls are over. Good news for semiconductors and tech stocks for a portion of the day. We run into the CPI report this morning at 8:30 a.m. Eastern, and while it appears that it's not as terrible as it looks, because sure, it's up, but not as up as people anticipated, the internals aren't great. The tariffs are showing up. If it weren't for a housing market price slowdown, you'd probably see more of the tariffs. And so there's two bad stories to tell. The market doesn't like it at all as the day goes on. Yields continue to spike. 30 years clear 5%. Stocks trade heavy. The Russell's crushed to the tune of 2%. Even Bitcoin's down 2.86%. Our sweet prince silver is off by a healthy 1.73%. It's not all bad news, though. Those playing for a dollar bounce are continuing to see it play out. The yen cracks onto new lows. The euro's below 117. The British pound trades below its 50-day moving average for the first time in 5 months. So things are happening here as we make our way through this Ides of July. That's not a thing. But we do cross the halfway mark of the month here with a little bit of a bump higher in volatility. Ilya, I think the report itself this morning is worth discussing, and I took the liberty of breaking it down on Futures Power Hour. But you mentioned the same thing I did, and we have not talked about this yet today, on air, off camera, anywhere. Core goods inflation. That's going bump in the night right now, and it's weighing heavy on the bond market.
That's right. So I'm going to have granular charting on this for macro money right after this show. So if what we're about to say needs a visual for you, and I think it does, I think it helps to kind of visualize what's going on, stick around. After this hour, I'll show you all of the charts on this. But the short story here is, obviously, most inflation is still locked in the service sector. Of course it is. The service sector is the biggest part of the overall economy. No surprise there. However, we have seen no meaningful goods inflation basically in 2 years. This is not that anymore. The biggest increase in contribution to the headline inflation figure came from the goods side. Now, the overall contribution was still small, only 0.13 percentage points out of the 2.7% headline, which came in exactly as expected, was accounted for by goods. So not huge. However, the change in contribution from May to June was 4 times bigger in goods than it was in services. Services increased. It's by far the biggest. Sure, none of that's new. But momentum in price change, the inflationary thrust, it's in goods. And that's the part that's scary because, of course, that's exactly what the Fed was so afraid of. That the tariffs will eventually start to feed into goods inflation. And that their job then is to keep it from spilling over into overall inflation expectations, because were that to happen, it would become sticky. And so the markets react in a understandable way. They slash rate cut expectations for this year. We're down to 38 basis points. That's not even 2 cuts. That is now less dovish than the Fed's own outlook. Moreover, it is the least dovish since, drumroll, February 19th. There's the top in the S&P earlier in the year before that massive sell-off. This is the most hawkish that Fed policy expectations have been since right then. And the outlook for 2026 is now the most dovish since the contracts started to trade for those periods. So we have exactly the sort of thing that we would surmise here on the show for the past couple of weeks that the markets would be afraid of. That they want cuts and that the data is going to tell the Fed not to do them.
The data may be telling us that already, if that's what you read through in the inflation data today. And certainly you look at the breakdown, and were it not for about a third of the U.S. housing market in a bit of trouble right now, seeing year-over-year price declines, then you'd probably have a stickier inflation report to the upside. But Dylan, if it's the tariff side of the problem, the news from last night, to me, should be as informative as anything. China, our great geopolitical adversary and rival, the country whose economy is eating the world and going to flood all of our Western developed countries with their cheap goods that kill our jobs. We're going to give them more of our advanced AI chips. NVIDIA, AMD are going to be selling overseas once more to China. But we're going to be tariffing the EU at 30%, Canada at 35%. What's going on? Is this just all kabuki theater, Mr. Radigan?
Caught up on this, Vecchio? How many times? Here's the thing, okay? The same way that the oil trade, when there's a World War III happens and oil spikes, you sell it. When Trump tariffs get all cocked up like they are, then you buy them. The tariffs are not going to happen. This is a buying opportunity. The only reason I'm not here jumping up and down is because my boy Ilya is here and I don't want to hurt his feelings. And he might
actually agree with you on the tariffs.
Well, on the tariffs, I'm sure you do. So let's talk about this because I think we probably
actually agree with you completely on the tariffs.
So you buy the tariffs.
I told Vecchio as much over text last night. It's like that scene in Die Hard 3 where all of a sudden Bruce Willis stops and goes, "Wait a minute, it's a heist."
But so here's my question for you, Ilya. Whenever there's a tariff super scare, you buy them. Okay, fine. Just like when there's an oil super scare, you sell them. But we did get this data today, which does show that there's that's not nothing, in my opinion. Like
that's real.
That CPI data to me was not nothing. I would like to say it was nothing, but I don't believe I could say it's nothing because I think it's something.
That's real.
And so. The reason I'm not just like, buy them on the tariff madness is because, well, you might buy them on the tariff madness and you'll be right on the tariff madness, but I can't help you out on the inflation / delayed rate cuts / slower economy. And I don't really know how to reconcile how much of the sell-off is tariff madness, which is just a temporary moment of madness, and how much of the sell-off is legitimate concern about higher costs, higher inflation, slower growth, and later rate cuts. And I don't know how to reconcile those two things. So I
think we should have a sense, and obviously this whole thing is a moving target. But I think when last week there was a bunch of tariff announcements, and the only thing that seemed to care was copper because the announcements spoke to it directly, but it didn't spill out elsewhere. I think that told you the markets are over the noise of this thing. What they want isn't the circus. What they want is economic data saying the stuff is real. And the problem with the CPI data is it suggests that, yeah, it is. And so the question, I think, goes back to, it's very, by the way, it's poetry in motion, really. That the Fed calculus for this year is back to mid-February, late February. Because what were we concerned about then? It wasn't tariffs conceptually. The time to be concerned about that was November. It didn't happen. The markets didn't care. We've said this a gazillion times. They were concerned about growth. They were concerned about real economic outcomes, because business and consumer confidence surveys started to tell you we are in freak-out mode over this tariff rollout. Holy moly, this is going to be bad for growth. And then the hard data was delayed, and the Fed kept coming out and going, we know it's going to be delayed. It's always delayed. And the White House keeps delaying the tariffs themselves to some extent. This takes time. The economy absorbs things over months, not days or weeks. So we have to be careful. We have to wait and wait and wait. Well, they're showing themselves to have been somewhat accurate. It's early days yet. It's one piece of data. But so far, it's looking like the freak out in the PMIs and the ISMs and at the Fed got its first big chunk of evidence today. It started, by the way, already in the PPI data going back to March, April. But this is a big headline thing. And it's not about, oh, the tariff circus is this or that. It's about, here is the growth implication.
But I guess, okay, great. I agree. And when it comes to an investing thing, whether it's indexes, commodities, all the things that we talk about, is it even possible to, with any granularity, to differentiate one from the other? Or do you think that basically you're like, listen, if I'm Ilya, I know I'm right, because tariffs are not, even if the tariffs are going to end up being, what we all know, 5-10% reciprocal, sort of kick the can, kind of basic, some sort of moderate, whatever thing.
Sure.
But the reality is it is not going to create, it is creating inflation.
Yes.
Fact. It is delaying rate cuts, or it is likely to delay rate cuts, highly likely, fact. And it is slowing growth.
Yes.
And the markets are at or near all-time highs.
And are telling you today that now that they have hard evidence that all of these things are occurring, they don't like it.
And so if you were to put on, if you were me and you had nothing, I'm long the dollar, I've been in and out of oil, I haven't done anything with stocks for months because I always fuck it up, excuse my language. Sorry, Chris, I'm sorry. I didn't mean that. Was slipped out. Call your mom. Tell her I'll get me a
hide your kids, hide your wife.
I'm sorry. I'm really sorry. And so, but if you were going, I'm sorry. I apologize. But it's true. That's what happens when I get involved with stocks. That happens. I up it up. Okay. Anyway, so if I was to originate a new short thesis today,
yes,
based on this information, because obviously there's a little sell-off today, but this is nothing, and I want to sort of get into a 45 to 60 day arc.
Mm-hmm.
Because there's going to be more inflation, there's going to be more slowdown, there's going to be, even if the earnings are good, there's going to be some cautionary guidance and all the jazz, and the rate cuts are not going to happen. Where do you put your best? I give you $5, you get 5 positions, $1 each. What are your 5 best new positions? Or 3? I would corner you, but
so vol is incredibly cheap still. IV ranks in the stock indexes is incredibly cheap. So put verticals there are still very cheap. NASDAQ, S&P, Russell, I have all 3 on at this point. I think the dollar keeps going higher, and probably the place to really look at that is the yen. It broke a big range today. The euro didn't quite break its range. The pound didn't quite break its range. The yen looks like it did. So that's one. And then the other thing I would be looking at very closely is gold, which is down a little bit today with the higher yields and the higher dollar, but it is not running away anywhere. And that is a sign of impressive strength. Like, this is an environment where gold should look terrible, and it does not.
Yeah, silver looks terrible comparatively. It's not weathering
because
the storm.
it's got that risk on sheen on it as compared to gold. Gold today looks like the Incredible Hulk got bashed with a 2x4. The 2x4 broke and caused no damage.
That's comic accurate. I'll allow it. When we look at what's happening in the metals market, specifically in
I am nothing
silver,
if not comic book accurate.
we do see a pullback to basically the 1 week moving average today. That comes in at 38.02 in the SIU 5 contract, but our close is 38.04 or so right now. So there's still a hold there. We touched above 40 in yesterday's session in the end of year SIZ 5 contract before reversing. Dollar up, yields up. A little bit of growth negativity as well. We can't dismiss the fact that this is all interrelated. So it comes back in. Gold's holding its ground despite a little bit of weakness there. And then we see Bitcoin likewise, which was a high flyer. A little bit of disappointment perhaps today being front run. There's some legislation up on the Hill right now related to stablecoin, digital coin, anti-CBDC legislation. And one of those votes just failed in the House. Now, Polymarket says there's still a 93% chance that the bill's going to pass by the end of this year. So if this is a...
Appropriately, they dropped the DOJ investigation against Polymarket today.
What are the odds? I wish we could bet on that one. I would have taken the other on it. I would have taken that trade, given everything we've seen. So it's, you could see though, there was this kind of like period of reckoning around the data release this morning, Dylan, where, you know, you look at how the market responded initially. It's like, oh yeah, oh, inflation's good. We're good. Oh wait, that's the wrong report. That's NVIDIA. Great. Okay, here's our inflation. Okay, yeah, we're fine. It's not as bad as we thought. Wait a second. Let's look through it. We're looking through it. We're looking through it. Oh God. Okay.
And then you know what they said? You know what they said around there? They said, oh,
Yeah. And Trump said that Powell is too late, of course, and that we need lower rates right now.
How do you lower rates when the cost of everything is going up as a government policy?
4-month high, by the way, on the inflation rate, both core and headline. So we've transitioned into ergonomics apparently over there at 1600 Pennsylvania Avenue.
And you know what's
I'm
so
going to
interesting?
Turkey, I think, next week. I'll check in on the whole situation.
See what they think about this. They have a level of expertise in nonsensical monetary policy that's second to none, really.
Do a little man on the street. Chris is trying to do his job. I'm sorry.
No, I'm really not. I'm trying to get banned from Turkey, and so I'm thinking if there's a way.
We might be already, man.
Don't do it on my dime. I'm going next week. I like it, Turkey. These are my people. Leave me out of this.
I'm just saying, if like a Radigan is arrested in a bazaar,
I'm going to be on.
And I take credit for that.
I'm going to be in Turk Buku, baby. You're going to find me in the sliver.
Yeah.
You're going to find me in a perfectly fine situation. Don't.
Yeah. For the record, I have said nothing disparaging about the Turkish lira in a long, long time.
Anyway, you were going to say, sir.
You know, it's fascinating when we look at some of the mechanical methods of setting Fed policy right now. One such way is the Taylor rule, which is taking a look at what would the Fed funds rate be, assuming growth and inflation and unemployment rate statistics, and you assume certain run rates of growth, right? So you figure out growth gaps, you figure out the employment gap, the output gap. And right now, given where things stand, from a variety of metrics, the Fed funds rate should probably be higher at the same level, right? White is around the same level. Green means the rate needs to be up. Red means we could use cuts. Most of these are white or green. So you guys talk about a Fed that's losing the ability to justify cutting rates down the line for the reason that they've stated the tariffs, but for the tariffs, they would have cut already.
Yeah.
That probably gained some credibility here today, which is why on the other side of this inflation data, this is the key metric here. We go over to our CME Fed Watch tool. On the other side of an inflation report where the headlines were in line or just below the expectations, Fed cut odds went down for the month of July. They went down for the month. Yeah, so 4% there, but for the month of September, we lost, we'll call it 6.5% net in one day.
Yeah.
So let's, we look at the hold from 37.4 up to 44.1, 6.7%. This is not the data that you want to see if you're Trump. And that actually, Ilya, speaks to the whole possibility where we have expiration tomorrow. Maybe the market bounces back a little bit. But on the other side of this week, when you get into your seasonal peak, the market tends to peak, close on the 17th, the 18th, it starts to go down. You get another minor swing higher at the end of July, perhaps into a new local high for August. But then the market really starts to suffer. Volatility seasonally basically moves up from here through, which is the second of the two Jewish holidays, Ilya, Yom Kippur or Rosh Hashanah?
Yom Kippur, that's right.
Yom Kippur. Okay, Gentile. Okay, so it basically rises from now through Yom Kippur.
No excuse.
I've watched
Don't
enough.
worry, we are here among you to clarify.
I should know, Dylan, right?
And you're a New Yorker. New Yorkers are better. Being a New Yorker is more Jewish than being a Jew.
So, there are many such cases. In any event, you have this seasonal window where through that second holiday, from the third week of July through the second week of October, volatility tends to poke up. So I'm still, after all of this today, I'm feeling a little bit better about my longer dated view, Ilya, where it's like this week I'm riding the rails higher in the NASDAQ with calls that expire next week. That still made some decent money today, all things considered.
Yeah.
But I have started to layer in those puts. And those puts to me feel a little bit more comfortable today because if we go into a window where the Fed doesn't cut in July and is telling us that they can't cut because of tariff reasons, we have a pipeline of data coming now that's likely going to show some increased tariff-related inputs. And look no further than what happened with food. Coffee was up coffee is being tariffed. We do not have the climate to grow it here. Coffee was up 2.2% month over month. Citrus, oranges, limes, lemons, grapefruits. There's like
we tariffed tomatoes from Mexico today.
Well, forget that today. We could see the citrus category in the food imports up over 2% month over month. We're just making things more expensive.
Were people about eggs? So how angry are they going to be about coffee, oranges, and now tomatoes?
Tomato sauce? Dylan, that sounds like anti-Italian discrimination.
It's a direct assault, frankly.
Up 1% as well. Also checking in on the losers there. We got ASML down 7.4%. That is after that broker action. And also Ronnie earlier talking about how he possibly has to have a change of heart there with his mate saying, ASML, if you love your grandchildren. But today, if you don't love your grandchildren, ASML down more than 7% there. Virgin Galactic also down almost 3%. NEO down 1.6%. And also Nvidia. That's the one I've been looking out for because Nvidia is down almost 8% after silently heading towards the meteoric highs of 4 trillion in terms of market cap there. Also checking in on ASML as well. For those of you just checking in right now, ASML down because their projections also were downbeat and investors did not like that. ASML CFO, this just coming through the wire right now, saying customers want to know how tariff discussions pan out and that they're keeping their powder dry in terms of signaling exactly how they see their capex for 2026. So this is an interview and in response to their outlook, suggesting that they may not hit their targets for 2026. Right, Nvidia. Let's just have a quick close-up look at Nvidia there because Nvidia, of course, is on the downward trajectory there. However, it has come from a very strong upward trend there. And Nvidia is down almost 8% there because Nvidia's chief executive has also come online now to say that the openness of DeepSeek has made it possible for every country and every industry to engage with AI. Also, a CEO saying it will take them time to ramp up their supply chain. Don't forget that NVIDIA is facing a huge amount of competition from many of competitors, especially in China, and that is where Jensen Huang is right this moment in Beijing for the supply chain conference to talk about how they are going to face this off, and also the fact that H20 can now be sold in China. They have confirmed this, and H20 is part of the rare earth negotiations, but Jensen Huang saying he has no inside information about the negotiations between China and the US. There may be more comments coming from Jensen a bit later, but those are the nuggets for you at this point. Shrimp Fred, welcome back. It really touched my heart, you people. All of you that, we rushed back as soon as we could. I also put on the Twitter page as well, the behind the scenes. Let me try and get that up for you because I did record it as we were trying to get out there. And here we are, you see all of us trying to take what we need, but, leaving our life belongings here. Producer Phil trying to keep us safe. Thank you, Producer Phil. Right, Neil Brewster, morning to you as well. Shrimp Fed, don't forget, I will be showing you that short interest trick that I found for you. Stay there because we have Aaron and Martin coming up next.
Okay guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money just sat in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest, and it's days like this. We get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically in investing that you can from cash. And that's not saying people go out and take a load of risk. It's about education, and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash.
Hello, welcome back after that brief hiatus. This is Under the Macroscope. I'm joined by Martin Harris once again. How you doing?
Good, thanks to you, Aaron. We obviously missed our earlier slot, but we do come back with a new name.
We do. I'm not sure who voted.
David Boyce.
Was it? Yeah. Okay. So thank you very much, David Boyce, for watching.
Under the Macroscope. Send him a Greg sausage roll.
Yes. The vegan ones are actually very nice. I mean, since they jumped onto the scene, I have to say. Big fan of those.
I know that you were vegan.
I'm not vegan. I just jumped on. You know when the vegan sausage rolls came out and everyone was like, "They're the new best thing since sliced bread." I tried one and I've been converted.
Right.
But I still enjoy.
That's a very vegan thing to do, which is to tell people that you eat vegan.
Trust me, I'm not vegan. I went to Buenos Aires in December, had a steak there, and could never be vegan. So yeah. So obviously we've seen some interesting always interesting things coming out over the past, I'd say, since the beginning of the year. We knew things were going to be volatile with Trump coming into power. But we've seen tariff concerns come back a bit. And yeah, I mean, the market's not reacting massively, but we are seeing a bit of a reaction, aren't we?
Certainly. So I think with the tariffs, there is a economic impact that potentially goes unnoticed. Tariffs currently amount to about a 1.6% weighted average US import. And that's up from roughly 1% at the start of the year. So total US consumption is going 1.6% additional is now going to be based just off tariffs. So this equates to a $500 billion tax on US importers. So that's a dramatic increase that we saw.
And what we've seen quite interestingly is inflation data coming out, which was soft. But if you actually look under the bonnet of the inflation data, some of the heavily imported goods is where you're seeing the highest increases of inflation month on month, year on year, and the highest since 2021. It's probably a bit early to say this is all tariff concerns, because we've only had them for not even 6 months. So, but it's a bit of a concern, I'd say, that we're beginning to see some reaction in the data.
Exactly, and we're going to see more of that because there was some tariff-induced front-running. So people bringing imports into the United States pre-tariffs.
Absolutely.
And so only now we're starting to see sort of the data coming out from May suggesting tariff-induced price increases. June will likely see more, and I think as time goes on, depending on the type of goods as well, non-perishable goods are going to import them in bulk, as well as autos were a big thing to try and get autos into the United States and increase inventories prior to the tariffs.
And I think someone who could be disadvantaged by this is the Japanese. They're big exporters, and particularly in the auto space, US market. They're going to potentially may have to look elsewhere if there's heavy tariffs placed on Japanese auto imports for the US.
Yeah, I mean, autos all have their own sort of carve out in the tariffs. Certainly, when I think Japan goes up to a 35% tariff, but because most of the imports are autos, they have their own specific sort of tariff applied to them. So it's not just so broad based. So it's actually somewhat lower, and Japanese autos don't have a different sort of rate from European autos yet.
Yeah, no, absolutely. But it's just obviously a big part of the Japanese economy. So interesting to see how that pans out. I think something that we've discussed, throughout the beginning of the year really is how asset classes are going to perform and how things have done this year. And obviously we've seen a lot of volatility. So I'm going to put up a chart just now, just to show how things have done this year. And this is from Creative Capital, from their investment strategist, Charlie Bilello. And what you can actually see here is if we go to this sort of section here, where my mouse is, we can see that, this, asset classes this year have actually returned 100% positive returns, which is pretty impressive, given the fact that we've had, all sorts of volatility, bouts of volatility, basically throughout the whole year, upside, downside, and but bear in mind this is dollar-denominated returns, and if you were bringing that back as a euro or as a sterling-based investor, likely that you'll see a fair amount of these gains eroded. But I mean, if we just take a look at some of the top few, gold has done well. It's sold off recently, which is the top one, 27.7% US dollar-based returns, and even throughout, the likes of commodities, US large caps, US value, even long duration treasuries are sort of flat for the year. So really quite interesting data coming out of the year. Obviously, this is, just over halfway through the year. So still a long way to go.
Yeah, so I think overall message here really is that dollar weakness has eroded your gains as a foreign investor if you are concerned about what your returns look like in sterling or euros potentially. Would you agree with that?
Totally. I think more than ever, I mean, investors will think of just the asset class when investing. But this year it's highlighted the fact that when you have a very strong currency, hedging isn't always a costly idea, which is unnecessary. Sometimes it can be very necessary and very important for investors.
Yeah, I think there's an element here where we've got rates in the United States as well as the fiscal situation alongside a third element, which is the rotation away from US assets, all kind of combining. And so you're getting these returns in the United States, potentially, and I mean, some of those we're looking at gold, for example, but we just have a dollar denominated return there. You've got these extreme valuations in the United States that have seen equities rotate away from US into Europe. Europe, you would have had better returns than US, but also there's concerns now around sterling. My feeling is that we've got a bit of a cyclical trend not concerns in sterling, concerns around US dollars. My feeling is that whilst there's some dollar weakness, what we're not seeing yet is what would make me really concerned about US dollar is that if the US economy was on a lower growth rate to the rest of the world, that's what we're not seeing.
Then we would see what a sort of collapse.
I think that's when I would be. So I mean, one of the messages is kind of like, what do I not hold any US assets? Do I not hold any US dollars?
You can buy hedge share classes if you're worried about that. If you're bullish on the asset class, iShares. I'll give you just a generic example. iShares, for example, will have an ETF which hedges with derivatives in the ETF, will hedge it, so you don't take the currency risk if you're bullish on, say, the S&P 500.
I mean, off the top of your head, how much more expensive is it to go for a hedge?
Probably I'd say at least 10 basis points higher. So you obviously have to pay a premium because they are engaging in a series of trades to hedge the currency, so you don't, there is an extra layer to the product.
Okay. Yeah, I mean, I don't have the answer on that. Something to look at, though. They are typically, more expensive.
Yeah.
But I don't think it's enough to warrant not using them.
Yeah, for certain circumstances, absolutely.
Yeah.
Absolutely.
I think my message is that you don't necessarily have to go for the hedged. We are in a bit of there is been sort of a structural decline in US dollar because, you've got a Trump administration that wants a weaker dollar. Weaker dollar means that manufacturing in the US and US exports become cheaper.
And conversely, people can't import as much as well.
And exactly. The market is less reliant on external suppliers. So it's an interesting dynamic, but I don't think that there is a long-term concern yet, unless there's a decline in the fiscal situation or a decline in the macroeconomy of the US, whereby the US is now moving at a slower rate relative to the rest of the world. That isn't the case. They've been, aggressively growing. Still going to be concerned about the US consumer, but on the back of all of this, we still could see rates, the pressure on whoever's next, whoever replaces Jerome Powell, to cut rates. So you've got this US economy that is still firing, and rates could still be cut. And that,
But inflation's obviously come in at not a terrible level, but it's still elements of it are sticky. And I mean, is there a need to cut rates? I mean, we've seen interest rate expectations for cuts come down massively.
I don't think there is a need to cut rates, but I think politically, I don't see a way around it.
Yeah. So I think we're going to see how much Trump and Powell are going to butt heads, because they have a track record of doing that. I mean, Trump has said some pretty funky things about Powell in the past.
Trump does seem obsessed with interest rates.
He does. We have a question here from Mervyn Jardin. TLT trailing yield is 4.45%, so why is it showing 0.4%? This actually isn't the yield, this was the return of the asset, so it's just the price return it's showing. So 0.4% is the dollar-denominated price return of TLT, which is the long duration treasury ETF, which is available mainly for US investors. We've got a different equivalent here, but that's, I guess, when people say TLT, they're talking about long-dated treasuries. But yeah, I mean, I think something that really caught my eye on that return graph was obviously gold. We've seen a bit of a fallback in the returns sort of over the past month or so, quarter even, I'd say. I mean, do you think there's still tailwinds for gold. I mean, I think it's something that we discussed, that, you know, there's positivity from central bank buying, and also it thrives on inflation and geopolitical instability. And with increased tariffs, could inflation still be lingering? And, you know, would that propel gold enough, basically?
So, I mean, the kind of what we're discussing is that, you know, the initial tariff effects have started to appear in some sort of private sector data. Will it impact gold? I'm unsure. I think that the drivers of gold at the moment have rather been around defensive positioning, geopolitical risks, things like that. I don't think that inflation yet is not priced into where the gold price is.
Sure. Yeah.
Do you have thoughts on that?
Well, I think that, you know, if inflation does creep up, I think you'll see buying. Obviously, gold's at a higher level than it's been ever, really, the past year, the past you know, number of months. It's seen some sort of pretty astronomical highs. I think there are some tailwinds, certainly from the geopolitical side of things, if that creeps up, particularly with the Middle East, with Ukraine, Russia. If that you know, flares up, particularly in those regions, that could be sort of something which gives gold a big tailwind. But obviously those events are quite unpredictable unless you are, you know, in the Oval Office. So, I mean, from what we've discussed, we don't necessarily think that the conflicts in that sort of region, Middle East and Ukraine, are completely done. They might go quiet for a while, but I think from our perspective, it's nice to have that extra lever in the portfolios to lean on if, you know, the situation develops where equities and bonds both sell off if there's concerns, and gold is obviously a safe haven traditionally.
Yeah, I think maybe just a question out to whoever's listening, to the two people who might still be on the video. If they've got any questions around investments that they want to send through, it's really, now we have an Ask Me Anything type of session available. Is there anything that you've been looking at in the last week that's caught your eye in terms of the investment landscape?
Well, I think from what's been quite interesting for me is that we obviously look at, you know, since the beginning of the year, really, we've looked at tariffs quite extensively. And as markets, at the beginning of the year, markets were very concerned about tariffs. You know, really, it would poison sentiment, and people would really sell off and get quite concerned about how tariffs would affect the world. Now, tariffs are coming back and forth and back and forth. And they're not necessarily poisoning sentiment, they're making it a bit sour. So investors are getting used to this sort of rhetoric coming from the Oval Office, from the White House, saying that you know, tariffs are going to come, they're going to be placed on Japan, they're going to be placed on here. We're not seeing these huge declines in stocks. We're seeing some volatility, 0.5%, 1% here. We're not seeing those huge moves at the moment. Obviously, that can change. But it's quite interesting to see that investors are obviously understanding that things can move quickly on that space, whether that's the taco trade, whether that's the idea that deals can be struck. It's the idea that, well, the US economy is also strong. So
yeah, I think I'll reiterate sort of what I was talking about before, but maybe make it more clear, is that the increase in US tariffs will have an impact on the global economy. Tariffs in place currently amount to a 16% weighted average of US import tariffs, and that's up from 2% at the start of the year. They have already collected over $300 billion in annualized tariff revenue, and that is expected to be $500 billion tax on importers once we include the pre-existing tariffs with the new ones that are supposed to have come into effect on the 9th of July. We obviously had the pause on the reciprocal tariffs, but I think the message from Trump around the, you know, starts with the tariff really is just a negotiating tactic. But it is disruptive to global economies, and it's
absolutely
to shipping.
I mean, it's an interesting one. I think he's, you know, the motives are unclear, but I think he's concerned about other countries gaining hegemony economically from the US. I think that's something that's of paramount importance to Donald Trump. Interesting question here. Any thoughts on oil?
Oh, you can start that one.
I'll start that one. Obviously, we've seen a huge amount of negative price activity in the space, and that's, I mean, mainly as a result of sort of OPEC with their oversupplying. But we know that oil can be extremely volatile. One thing that's caught my attention with oil is obviously the conflict in the Middle East, so with Iran and Israel. You know, we saw oil actually sell off quite significantly when, you know, many thought it would sort of pop. There was an element where it rose very sharply when the initial this was sort of initial round of hostilities broke out, and then it fell quite quickly as Iran's response was perceived as relatively weak on Israel and not too damaging to the Israeli economy and you know, the infrastructure in the region. I think the concern is if hostilities rise again, obviously Iran control much of the Straits of Hormuz, and it might be somewhat, from sort of a political sort of point of view from the regime, it might be somewhat precarious for them to do it, but they can close the Straits of Hormuz, which controls 20% of oil supply in and out. And if they did that, I think one would expect oil prices, even though most of the oil from Iran specifically goes to China, you know, if supply's cut, it's going to affect prices globally of the asset class. I mean, what would you say to that?
Yeah, I agree with that. I think there's also news coming out of there was the 9th OPEC International Seminar. Ultimately, the cuts that were in place to oil by the OPEC committee were reversed when the conflict between sort of Iran, Israel, US started. The messaging is just that there's overall positive mood around
supply, right?
Around supply, exactly. And so the oil market is looking to absorb the sort of news around capacity increases. It's looking to come out with, they're not concerned about a decline in prices. They're looking to push ahead with production. So that's kind of been the focus of OPEC at the moment. I don't know if there's it sort of translates to, there's concerns around the economies that are in the oil producing nations, and that they actually at this point need to be pumping up more oil, and so they're happy to combine and adhere to OPEC sort of agreements around increasing production.
Yeah. No, an interesting space, and I just think with oil, things can move very quickly. So that's something that we should be aware of, is that, you know, I mean, obviously during COVID, we saw things move very quickly with the oil price. And look, if things change in that region, we could expect big moves, both on the upside or downside. And I think that's all we have time for in this segment. So thank you very much for tuning in on Under the Macroscope.
The inflation report wasn't as bad as people expected, or was it? It's Tuesday, July 15th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Elizabeth X in San Francisco, Dylan Radigan's in Milan, here to take you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're on the website, tastylive.com, the platform Tasty Trade, welcome. Thanks for tuning in. If you're on YouTube, thanks for joining the conversation. Tell us what you think of this action today. The pop higher overnight, thanks to NVIDIA being allowed to sell their top-of-the-line chips to China. Okay, I guess the export controls are over. Good news for semiconductors and tech stocks for a portion of the day. We run into the CPI report this morning at 8:30 a.m. Eastern, and while it appears that it's not as terrible as it looks, because sure, it's up, but not as up as people anticipated, the internals aren't great. The tariffs are showing up. If it weren't for a housing market price slowdown, you'd probably see more of the tariffs. And so there's two bad stories to tell. The market doesn't like it at all as the day goes on. Yields continue to spike. 30 years clear 5%. Stocks trade heavy. The Russell's crushed to the tune of 2%. Even Bitcoin's down 2.86%. Our Sweet Prince Silver is off by a healthy 1.73%. It's not all bad news, though. Those playing for a dollar bounce are continuing to see it play out. The yen cracks on to new lows. The euro's below 117. The British pound trades below its 50-day moving average for the first time in 5 months. So things are happening here as we make our way through this Ides of July. That's not a thing. But we do cross the halfway mark of the month here with a little bit of a bump higher in volatility. Ilya, I think the report itself this morning is worth discussing, and I took the liberty of breaking it down on Futures Power Hour. But you mentioned the same thing I did, and we have not talked about this yet today. On air, off camera, anywhere. Core goods inflation. That's going bump in the night right now, and it's weighing heavy on the bond market.
That's right. So I'm going to have granular charting on this for macro money right after this show. So if what we're about to say needs a visual for you, and I think it does, I think it helps to kind of visualize what's going on, stick around. After this hour, I'll show you all of the charts on this. But the short story here is, obviously, most inflation is still locked in the service sector. Of course it is. The service sector is the biggest part of the overall economy. No surprise there. However, we have seen no meaningful goods inflation basically in 2 years. This is not that anymore. The biggest increase in contribution to the headline inflation figure came from the goods side. Now, the overall contribution was still small, only 0.13 percentage points out of the 2.7% headline, which came in exactly as expected, was accounted for by goods. So not huge. However, the change in contribution from May to June was 4 times bigger in goods than it was in services. Services increased. It's by far the biggest, sure. None of that's new. But momentum in price change, the inflationary thrust, it's in goods. And that's the part that's scary because, of course, that's exactly what the Fed was so afraid of. That the tariffs will eventually start to feed into goods inflation. And that their job then is to keep it from spilling over into overall inflation expectations, because were that to happen, it would become sticky. And so the markets react in a understandable way. They slash rate cut expectations for this year. We're down to 38 basis points. That's not even 2 cuts. That is now less dovish than the Fed's own outlook. Moreover, it is the least dovish since, drumroll, February 19th. There's the top in the S&P earlier in the year before that massive sell-off. This is the most hawkish that Fed policy expectations have been since right then. And the outlook for 2026 is now the most dovish since the contracts started to trade for those periods. So we have exactly the sort of thing that we would surmise here on the show for the past couple of weeks that the markets would be afraid of. That they want cuts, and that the data is going to tell the Fed not to do them.
The data may be telling us that already, if that's what you read through in the inflation data today. And certainly you look at the breakdown, and were it not for about a third of the U.S. housing market in a bit of trouble right now, seeing year-over-year price declines, then you'd probably have a stickier inflation report to the upside.
Mm-hmm.
But Dylan, if it's the tariff side of the problem, the news from last night, to me, should be as informative as anything. China, our great geopolitical adversary and rival, the country whose economy is eating the world and going to flood all of our Western developed countries with their cheap goods that kill our jobs. We're going to give them more of our advanced AI chips NVIDIA, AMD are going to be selling overseas once more to China, but we're going to be tariffing the EU at 30%, Canada at 35%. What's going on? Is this just all kabuki theater,
Are you
Mr.
getting all
Radigan?
caught up on this, Vecchio? How many times? Here's the thing, okay? The same way that the oil trade, when there's a World War III happens and oil spikes, you sell it. When Trump tariffs get all cocked up like they are, then you buy them. The tariffs are not going to happen. This is a buying opportunity. The only reason I'm not here jumping up and down is because my boy Ilya is here and I don't want to hurt his feelings. And he might
actually agree with you on the tariffs.
Well, on the tariffs, I'm sure you do. So let's talk about this because I think we probably
actually agree with you completely on the tariffs.
So you buy the tariffs.
I told Vecchio as much over text last night. It's like that scene in Die Hard 3 where all of a sudden Bruce Willis stops and goes, "Wait a minute, it's a heist."
But so here's my question for you, Ilya. Whenever there's a tariff super scare, you buy them. Okay, fine. Just like when there's an oil super scare, you sell them. But we did get this data today, which does show that there's that's not nothing, in my opinion.
That's real.
That CPI data to me was not nothing. I would like to say it was nothing, but I don't believe I could say it's nothing because I think it's something.
That's real.
And so the reason I'm not just buy them on the tariff madness is because, well, you might buy them on the tariff madness and you'll be right on the tariff madness, but I can't help you out on the inflation / delayed rate cuts / slower economy. And I don't really know how to reconcile how much of the sell-off is tariff madness, which is just a temporary moment of madness, and how much of the sell-off is legitimate concern about higher costs, higher inflation, slower growth, and later rate cuts. And I don't know how to reconcile those two things. So I think we should have a sense, and obviously this whole thing is a moving target, but I think when last week there was a bunch of tariff announcements and the only thing that seemed to care was copper because the announcements spoke to it directly, but it didn't spill out elsewhere. I think that told you the markets are over the noise of this thing. What they want isn't the circus. What they want is economic data saying the stuff is real. And the problem with the CPI data is it suggests that, yeah, it is. And so the question, I think, goes back to, it's very, by the way, it's poetry in motion, really, that the Fed calculus for this year is back to mid-February, late February. Because what were we concerned about then? It wasn't tariffs conceptually. The time to be concerned about that was November. It didn't happen. The markets didn't care. We've said this a gazillion times. They were concerned about growth. They were concerned about real economic outcomes. Because business and consumer confidence surveys started to tell you we are in freak-out mode over this tariff rollout. Holy moly, this is going to be bad for growth. And then the hard data was delayed, and the Fed kept coming out and going, we know it's going to be delayed. It's always delayed. And the White House keeps delaying the tariffs themselves to some extent. This takes time. The economy absorbs things over months, not days or weeks. So we have to be careful. We have to wait and wait and wait. Well, they're showing themselves to have been somewhat accurate. It's early days yet. It's one piece of data. But so far, it's looking like the freak out in the PMIs and the ISMs and at the Fed got its first big chunk of evidence today. It started, by the way, already in the PPI data going back to March, April. But this is a big headline thing. And it's not about, oh, the tariff circus is this or that. It's about, here is the growth implication. But I guess, okay, great. I agree. And when it comes to an investing thing, whether it's indexes, commodities, all the things that we talk about, is it even possible with any granularity to differentiate one from the other? Or do you think that basically you're like, listen, if I'm Ilya, I know I'm right, because tariffs are not, even if the tariffs are going to end up being, what we all know, 5-10% reciprocal, sort of kick the can, kind of basic, some sort of moderate, whatever thing.
Sure.
But the reality is, it is not going to create, it is creating inflation.
Yes.
Fact. It is delaying rate cuts, or it is likely to delay rate cuts, highly likely, fact. And it is slowing growth.
Yes.
And the markets are at or near all-time highs.
And are telling you today that now that they have hard evidence that all of these things are occurring, they don't like it.
And so if you were to put on, if you were me and you had nothing, I'm long the dollar, I've been in and out of oil, I haven't done anything with stocks for months because I always fuck it up, excuse my language. Sorry, Chris, I'm sorry. I didn't mean that. It slipped out. Call your mom. Tell her I'll get me a
hide your kids, hide your wife.
I'm sorry. I'm really sorry. And so, but if you were going, I'm sorry. I apologize. But it's true. That's what happens when I get involved with stocks. That happens. I up it up. Okay. Anyway, so if I was to originate a new short thesis today,
yes,
based on this information, because obviously there's a little sell-off today, but this is nothing, and I want to sort of get into a 45 to 60 day arc.
Mm-hmm.
Because there's going to be more inflation, there's going to be more slowdown, there's going to be, even if the earnings are good, there's going to be some cautionary guidance and all the jazz, and the rate cuts are not going to happen. Where do you put your best? I give you $5, you get 5 positions, $1 each. What are your 5 best new positions? Or 3? I don't corner you, but
so vol is incredibly cheap still. IV ranks in the stock indexes is incredibly cheap. So put verticals there are still very cheap. NASDAQ, S&P, Russell, I have all 3 on at this point. I think the dollar keeps going higher, and probably the place to really look at that is the yen. It broke a big range today. The euro didn't quite break its range. The pound didn't quite break its range. The yen looks like it did. So that's one. And then the other thing I would be looking at very closely is gold, which is down a little bit today with the higher yields and the higher dollar, but it is not running away anywhere. And that is a sign of impressive strength. Like, this is an environment where gold should look terrible, and it does not.
Yeah, silver looks terrible comparatively. It's not weathering
because
the storm.
it's got that risk on sheen on it as compared to gold. Gold today looks like the Incredible Hulk got bashed with a 2x4. The 2x4 broke and caused no damage.
That's comic accurate. I'll allow it. When we look at what's happening in the metals market, specifically in silver,
if not comic book accurate.
We do see a pullback to basically the 1 week moving average today. That comes in at 38.02 in the SIU 5 contract, but our close is 38.04 or so right now. So there's still a hold there. We touched above 40 in yesterday's session in the end of year SIZ 5 contract before reversing. Dollar up, yields up. A little bit of growth negativity as well. We can't dismiss the fact that this is all interrelated. So it comes back in. Gold's holding its ground despite a little bit of weakness there. And then we see Bitcoin likewise, which was a high flyer. A little bit of disappointment perhaps today being front run. There's some legislation up on the Hill right now related to stablecoin, digital coin, anti-CBDC legislation. And one of those votes just failed in the House. Now, Polymarket says there's still a 93% chance that the bill's going to pass by the end of this year. So if this is
appropriately, they dropped the DOJ investigation against Polymarket today.
What are the odds? I wish we could bet on that one. I would have taken the other on it. I would have taken that trade, given everything we've seen. So you could see though. There was this kind of like period of reckoning around the data release this morning, Dylan, where, you look at how the market responded initially, It's like, oh yeah, oh, inflation's good. We're good. Oh wait, that's the wrong report. That's NVIDIA. Great. Okay, here's our inflation. Okay, yeah, we're fine. It's not as bad as we thought. Wait a second. Let's look through it. We're looking through it. We're looking through it. Oh God. Okay.
And then you know what they said? You know what they said around there? They said, oh,
And Trump said that Powell is too late, of course, and that we need lower rates right now.
How do you lower rates when the cost of everything is going up as a government policy?
4-month high, by the way, on the inflation rate, both core and headline. So we've transitioned into ergonomics apparently over there at 1600 Pennsylvania Avenue.
And you know what's
I'm
so
going
interesting?
to Turkey, I think, next week. I'll check in on the whole situation.
See what they think about this. They have a level of expertise in nonsensical monetary policy that's second to none, really.
Do a little man on the street. Chris is trying to do his job. I'm sorry.
No, I'm really not. I'm trying to get banned from Turkey, and so I'm thinking if there's a way.
We might be already, man.
Don't do it on my dime. I'm going next week. I like it, Turkey. These are my people. Leave me out of this.
I'm just saying, if like a Radigan is arrested in a bazaar,
I'm gonna be on.
I take credit for that.
I'm gonna be in Turk Buku, baby. You're gonna find me in the sliver.
Yeah.
You're gonna find me in a perfectly fine situation. Don't.
Yeah. For the record, I have said nothing disparaging about the Turkish lira in a long, long time.
Anyway, you were going to say, sir.
You know, it's fascinating when we look at some of the mechanical methods of setting Fed policy right now. One such way is the Taylor rule, which is taking a look at what would the Fed funds rate be, assuming growth and inflation and unemployment rate statistics, and you assume certain run rates of growth, right? So you figure out growth gaps, you figure out the employment gap, the output gap. And right now, given where things stand, from a variety of metrics, the Fed funds rate should probably be higher at the same level, right? White is around the same level. Green means the rate needs to be up. Red means we could use cuts. Most of these are white or green. So you guys talk about a Fed that's losing the ability to justify cutting rates down the line for the reason that they've stated the tariffs, but for the tariffs, they would have cut already.
Yeah.
That probably gained some credibility here today, which is why on the other side of this inflation data, this is the key metric here. We go over to our CME Fed Watch tool. On the other side of an inflation report where the headlines were in line or just below the expectations, Fed cut odds went down for the month of July. They went down for the month. Yeah, so 4% there, but for the month of September, we lost, we'll call it 6.5% net in one day.
Yeah.
So let's, we look at the hold from 37.4 up to 44.1, 6.7%. This is not the data that you want to see if you're Trump. And that actually, Ilya, speaks to the whole possibility where we have expiration tomorrow. Maybe the market bounces back a little bit. But on the other side of this week, when you get into your seasonal peak, the market tends to peak, close on the 17th, the 18th, it starts to go down. You get another minor swing higher at the end of July, perhaps into a new local high for August. But then the market really starts to suffer. Volatility seasonally basically moves up from here through, which is the second of the two Jewish holidays, Ilya, Yom Kippur or Rosh Hashanah?
Yom Kippur, that's right.
Yom Kippur. Okay, Gentile. Okay, so it basically rises from now through Yom Kippur.
No excuse.
I've watched
Don't
enough.
worry, we are here among you to clarify.
I should know, Dylan, right?
You're a New Yorker. New Yorkers are better. Being a New Yorker is more Jewish than being a Jew.
There are many such cases. In any event, you have this seasonal window where through that second holiday, from the third week of July through the second week of October, volatility tends to poke up. So I'm still, after all of this today, I'm feeling a little bit better about my longer dated view, Ilya, where it's like this week I'm riding the rails higher in the NASDAQ with calls that expire next week that still made some decent money today, all things considered. But I have started to layer in those puts. And those puts to me feel a little bit more comfortable today because if we go into a window where the Fed doesn't cut in July and is telling us that they can't cut because of tariff reasons, we have a pipeline of data coming now that's likely going to show some increased tariff-related inputs. And look no further than what happened with food. Coffee was up two. Coffee is being tariffed. We do not have the climate to grow it here. Coffee was up 2.2% month over month. Citrus, oranges, limes, lemons, grapefruits. There's like
we tariffed tomatoes from Mexico today.
Well, forget that today. We could see the citrus category in the food imports up over 2% month over month. We're just making things more expensive.
Were people about eggs? So how angry are they going to be about coffee, oranges, and now tomatoes?
Tomato sauce? Dylan, that sounds like anti-Italian discrimination.
It's a direct assault, frankly.
This, where I come from, they call this stupid.
What do you think the people in like Portofino are thinking right now? They're like, oh, my lemons are more expensive. I can't have my tomatoes. Like, who is this guy?
I'll tell you right now, in Portofino, they're not thinking about us.
No, they're not. I wouldn't be either.
This does not occur to them. They're like, will it be lobster or steak on the boat tonight? They're like, I hope the prosecco is properly chilled. That's kind of where they're at. They're not really.
Can I tell you what Portofino did for my flavor, my palate?
I can't.
That was the first place.
Yeah, please.
First place in the world where when I order a bottle of wine, I got Lay's potato chips as the side.
Well, no, aperitivo, you get it. That happens all the time.
Yeah,
Lay's potato chips and white wine is just an unbelievable combination.
But that, by the way, the aperitivo tradition, that, by the way, is the snack before dinner. Fantastic. We need to adopt it universally immediately.
I live in Italy,
How San Francisco hipsters haven't figured this out yet, I don't know. But I need to call all of my folks immediately.
And it's the best, like, low stakes social structure, because it's like it's not let's go out to dinner and blah blah blah, and it's not lunch or it's I'll catch you this afternoon for a drink and a chip. We'll have a chat. We'll catch you around. It's like it's designed for a social structure. But anyways, this is not the time or the place to evaluate the merits or lack thereof of the Italian social structure versus the rest of the world, because it's already been demonstrated vastly superior in every category.
All right. So we have our problem with bonds today. It's spilling over into gold, but it is, Ilya, we were touching on the currencies here. Dylan, Ilya, we're all on the same page with this, that the dollar looks like it's due for a bounce. I can't help but notice, Ilya, the problem that we were ascribing to the US dollar in April. We're seeing higher interest rates, the currency's losing ground. That's not how it's supposed to work. That's typically the sign of a crisis. It's sovereign risk being repriced or something else, one or the other. Right. In the UK, in Germany, in Japan, interest rates are going up. All of their currencies are going down. The dollar has interest rates going up too, but the dollar isn't the one suffering on the other end of this. Mm-hmm. The dollar's behaving in a very normal fashion. Yes. It's behaving a bit of like a safe haven, people need to get their hands on some US dollars kind of situation.
Yes. What do we make it? The dollar also really took it in the beak. I mean, it all happens in context here.
That's right.
Yeah, it did. It was the worst start to the year ever. Right? Dollars unpegged in 1971, August 15th, 1971. Nixon takes us off the gold standard. When the Smithsonian arrangement expires in 1973, basically everything else goes free float. And so since 1973, we haven't seen a start to the year like this.
Yeah. 73 is basically the genesis of the financial system as we know it now.
Right. So, but you now have your turn here in the euro. You lose 117. You have your yen breaking through 0068. Hopefully some people held on for that ride with me. The Canadian dollar's almost breaking down. British pounds below its 50-day for the first time since mid-February. And so that brings us back to DXY, where among the euro, the pound, the yen, that's 80-something% of the dollar index. This is a test of the 50-day here.
Yeah, it's a meaningful turn.
This is 1, 2, 3, 4, 5 times now that we've been back to the 50 since we crossed below it.
And we take out former support, become resistance. I mean, obviously, you don't want to do technicals too granularly on the dollar index. It's a basket. It's a little fuzzy. It's not real market action per se. But you were in a range. You broke out of the range. You're back in that range. So whatever breakdown we were looking at in late June it's a failed one now.
Do you think this is the bottom? Is the 50-day
Yes.
moving average the final boss, basically?
For now, I mean, I don't think that the sell-off in the dollar in the first 6 months of the year was a flimsy or a trivial thing. I think it speaks to the rise in term premium, that is general uncertainty and duration risk for U.S. assets. And there's this chart here from Morgan Stanley. Good for them to finally get on board. I've charted this a little bit differently over the recent months, but I've just been showing two curves, one showing the share of the break-even rate in the 10-year against the share of the term premium in the 10-year. And the break-even rate hasn't gone anywhere but down trend-wise, and the term premium has gone nowhere but up trend-wise as a share of nominal 10-year yields. We just showed it most recently on Macro Money yesterday. We'll show it again today. So this is a story of increased uncertainty. But to your point, what it's not is a story of credible sovereign risk. Because what happened in the first 6 months of the year is yields went down across the curve. They didn't go down a lot, but they went down across the curve. There was no shortage of appetite for U.S. sovereign debt. Nobody is out there saying that this is a credible, oh my God, the U.S. will default type of story. And of course it's not. That was always crazy. So when we look at what this is, it's sort of what I've been talking about for basically now 2-3 weeks. This idea that in the second half of the year, the market has switched gears. If the first half of the year was about, this is a growth scare, oh my God, it's a sovereign scare, oh my God, the U.S. is going to cut off its own nose despite its face. No, wait, no, it's not. Okay, deep inhale, deep exhale. What is it? Oh, it's a growth scare. And we're back to just what's growth going to do, and when's the Fed going to start handing out the Kevlar vests? And with data like this, with term premium rising, you have a difficult issue, because on the one hand, the markets are saying there's more uncertainty, give us the cheap money to paper over it, and the Fed is saying, nah.
I find it really interesting that, maybe that's what the exercise was in April and May, where the market was pricing this additional term premium. The chart I was showing deserves some explanation here.
I think so.
The gold line that you see, or brown, I don't know what colors people see these days, blue dress, black dress. Here you have a line that's a little bit lighter, and that looks at the relationship, just an OLS. Where was the Fed funds rate implied by the market versus the 10-year yield on a given close all days, April 2nd, 2024 to April 2nd, 2025. And then looking at that same relationship from the closes from April 3rd forward. And there is still that linear relationship, right? But the difference is, compared to where the market is trading on the implied Fed funds rate and where yields are operating, there seems to be a 40 basis point gap now, given the relationship we've seen play out over the past year. And that's to suggest there's an additional layer of risk that's been built in since what happened on the afternoon of April 2nd after the market closed? Oh, yeah, we got that phone board day from Donald Trump in the Rose Garden. And so April 3rd onwards, the market has applied a new price for US dollar denominated assets. And if we've already done that exercise here now, we're back to a normal world, the term premium can it inflate more? Maybe. Will it? Perhaps not. But if it's not, and we're in a world where people are looking for liquidity right now, and they're trying to, well, maybe these tariffs are real, what are the big trades on the board? Long stocks, pretty crowded. Short dollar, pretty crowded. And their volatility is pretty low here. So, Ilya, the currencies seem to be a little bit more appealing. If we're looking for a bit of a reversion, these are a lot more crowded trades right now based on the positioning data that we can see. The yen, the pound, the euro, a lot more crowded on a relative basis. than the NASDAQ or the S&P. So if we're going to get a big reversion, I really like playing it through the currency space right now, which is perfect because that's my bread and butter, how we came up.
Oh yeah. This is what we know.
But this is a really interesting case because now you're seeing other currencies like early April, higher yields, bad for the dollar, sovereign risk. Okay, well, in Japan, yields are shooting up across the curve. They're doing so in Britain. In Britain, you have negative growth. They're continuing to increase taxes. No one can figure out why the economy's stalling. It's Brexit. And in Japan, they have a rice crisis. Rice prices are through the roof. But because of the cultural significance there, the government's not going to import rice. They're trying to incentivize production nationally. There's an election coming up right now in Japan. And so the political party can't say, yeah, we're going to flood the market with foreign rice and potentially push out Japanese producers. No. So can the BOJ do anything except watch Japanese real rates erode in the short term? I guess not.
And so they've kind of said as much.
And so Japanese nominal rates, their JGB yields, they keep going up. The yen keeps getting weaker. And the dollar is now, despite its warts and all, where did all of this bring you guys? Right back to me, to the king dollar. I think, because Dylan, I think it's time.
It's classic. I mean, what did we see in 2008? The mortgage crisis was in the U.S. When everything hit the fan, where did capital go? The dollar. Why? Just unrivaled liquidity. And so as long as you don't have the sovereign spook, which was ridiculous because no borrower is more eligible than the U.S. no matter what's going on in the current environment, capital went to safety here. It went to liquidity. It cashed out into the most liquid thing. Sorry, Dylan, go ahead.
No. I mean, I think the only question is what's the most capital efficient way to be long the dollar? Full stop.
Highest bang for your buck in the IVR world is going to be in your Canadian dollar. And we're probably at a potential turning point right now in that regard. It's a place where I'm not having any exposure at present time, but I see these former highs that we have here in April.
Yeah, I'm watching
post-Liberation Day. We have our 50-day moving average here. We could do it through the typical tasty methodology, selling a call spread up here, risking 4 to make 1. We could go a little bit more cowboy out here and buy an out-of-the-money put spread. Out-of-the-money put spread would be risking a little over 5 to make, risking 1 to make a little over 5, 15% probability of profit. Obviously, when volatility is this high, it's prudent to maybe think about taking advantage of that. But the Canadian dollar with its 73.2 IVR, we talk about diversifying strategies, time assumptions, expressions of the same view. Perhaps the best way to do this would be, look, we have our short call spread in the Canadian dollar to harvest the vol, and then we go over to our yen, which is still exceptionally crowded, and we go out to, say, 85 days and look at the long 65, 66, rather long 66, short 65 put spread, and there's your 25% probability of profit, a 4-to-1 reward to risk. And so you kind of have bracketed there. You're playing the dollar on both ends. One of them needs the dollar to really get going. That's the yen side of the trade. The other is just about the Canadian dollar not rallying. And so you have a dollar bullish expression there, 2 different cloths. One's a little bit more risk averse. One's a little bit more leaning into it. I'm going to be doing both. I feel good about the dollar now.
Okay.
Because it's getting so hated. I already have my long yen put spreads on. I'm going to start rolling those down tomorrow.
Mm-hmm.
I think that fact that we find ourselves at this 50-day moving average in the dollar gives us a reason to pause. But if we were to flush through this cleanly, Ilya, we have not seen a close on the other side of it since February 12th.
Yeah. I mean, I've been long the dollar for about 2.5 weeks now. As you know, I started laying it on with the British pound. That was the one that broke first. I've since put it on in the euro. I've put it on in the yen. I've put it on in the Aussie. So it's starting to happen. I think it's got some more legs to keep going. There was a point today when it looked like the euro might get held up. It's basically at support now, which is a really interesting thing. So is the pound. So we might get a little bit of a reaction off these levels to give better entry points. The euro could bounce a little here, in which case I'd be looking for that as a selling opportunity. The pound, the same thing. The yen seems like it's broken, and that's a big deal because with the yen you don't get a lot of mulligans. Other currencies vacillate around levels sometimes before they have the real move, so they'll kind of poke through a level and then hang out a second to digest. When the yen runs, it runs. And so this could be big there. The Canadian dollar is interesting. It hasn't confirmed it yet. The Aussie is starting to confirm it with this move today. So possibly a significant double top now in the Aussie. So that's an interesting one. I think now with basically no Fed action in July a given and September watered down, there's a lot of runway here because there's no Fed meeting in August. There's a bunch more data that's coming. If this data is emblematic of the start of a thing, as it looks, we're going to get a bunch more numbers that are going to make this look more dollar positive. And of course, if stocks are going to break, then, and we certainly got some steps in that direction on this, I wouldn't say it's confirmed, but it's certainly starting to look very spooky. If stocks are going to break and the dollar is going to be the classic haven that it is in times like that, it's going to rip.
Yeah, one thing that we've seen so far in the earnings reports has been the fact that the weak dollar in Q2 did help some of these companies with multinational exposure juice their profits a little bit. And so a world of higher interest rates coupled with a dollar that's moving on up, probably not going to be good.
Coupled with a little inflation action on the side just for a friend.
That's that tough skiing environment that the Russell ran into in 2022, where those companies have smaller moats. Right, they can't really survive.
Maybe we should just back up the truck and go full madman on the Russell. You ever think about that, sir?
You know, the Russell's the Russell's at this spot where if you're not already short to give the Ilya of it all, right? You know, if you're not already long at the high, then what's the risk to reward? But we've already pulled back now into the 1 month today, the uptrend off of the April and June low, and then when I go to the 4-hour time frame,
you got to take out 2,200 essentially.
I have a head and shoulders pattern forming up here, which is a left shoulder, head, right shoulder, and in fact, I want to go to the 8-hour. There's a few things here that make why this is so interesting as a potential place. So shooting star for your left shoulder, evening star candlestick cluster for your head, and then bearish engulfing bar here for your right shoulder.
It's like textbook.
It looks good. And the right shoulder is below the left shoulder, which is necessary. So we're at that neckline right now, not yet broken because we haven't cleared. I have it marked off as 2210.3.
Yeah, so swing high. That's spike high right there. Yep.
This is the best place to buy.
You and I are looking at exactly the same thing.
I mean, but the trade here, Dylan, isn't to get short the Russell here. The trade for tomorrow is to buy the Russell here with like a 10 or 15 point stop. And if you hold this, then you're buying at trend support going back for the last 3 months. And that's what you should be doing in an uptrend. You should be buying at trend support. Here's the quip, though. If this
unless what you did was you sold it on the bounce into the formation of the left shoulder, which is what did.
Well, this is the other side of this. Everything that's been happening. What if this is a big bearish rising wedge that's been forming, and the trigger formation?
That's how I'm looking at it.
The trigger here is going to be this head and shoulders. So like tomorrow, I'm looking for a bounce in stocks. S&P is near the downside of its range. Russell's at the bottom side of its uptrend. But if they don't bounce tomorrow, look, the July
PPI tomorrow.
Tomorrow's the 16th.
Which suddenly matters in recent months because that's where the math on how much margin producers are giving up to insulate consumers from tariffs has been showing up.
So we'll see it in there.
We'll see it
tomorrow's the 16th. If the seasonal peak for the month is the 17th and then you just chop around with maybe a pop in the 30th or the 31st, like why fight those tides? I'm not going to fight those tides. I will take any equity longs off the table and sit with those longer dated S&P 500 puts and just coast for the next few weeks. And if I'm wrong, I lose a little bit of money being a bear. And I learned the very important lesson that being a bear is a stupid thing to do. No,
Sometimes.
no takers, no bait.
Sometimes
I mean,
until it
a
isn't.
long time ago. I mean, that's
Sometimes until it isn't.
I sit in awe of Ilya because of his he's got his micro short strategy. He's always in there getting kicked in the teeth, but it's only a small kick every time. And then when
just a little chip,
he's just
a little chip off the old canine.
He always has a slightly bruised nose at all times, but he never takes a full head injury. And then he's right in the room when it goes the other way, and he can step right into the whoosh. But God help you.
This has been kind of the thing with between the dollar and stocks in the first 6 months of the year. The dollar sell-off flattered the stock market by a lot. It also flattered my performance because for all the little dings I took on stocks, the dollar ran down, and it ran down way more than stocks rallied.
Yeah, for sure.
And so it's just, you never know with macro. The timing in macro is the hardest part of all.
Timing and everything is the hardest.
Say it loud, say it proud. The timing is very hard.
It's incredibly hard.
Which is
so
why
all you got to do is just manage risk.
But the only way you manage time is with position size.
That's right. Position size and trade structure and leverage management, because you're not going to know. So when you get a spot that looks risk reward appealing, you take a very modest shot so that you don't get killed, but worst case, you catch a little bit of a black and blue situation on the ribs. It's temporary. You'll be okay. And just wait.
It's funny when you say like the risk to reward, because if the stock market compounds at 8% and I'm not retiring for 30 or 40 years, it feels like getting long stocks at any given moment in time has pretty good upside convexity, risk to reward.
On that kind of a time frame, I totally agree with you. And I have a separate portfolio for things that do that.
Ilya's secretly a real bull. Like 95% of his portfolio is allocated bullish. And
bull, totally.
He only talks about the 5% that he leans on bearish with. Dylan,
totally. I am incredibly optimistic about U.S. growth, the U.S. economy, the ongoing next American century of economic prosperity and dominance. Totally on board with all of that. That's just not a 45 DTE cycle idea. That's a 10-year idea, 20-year idea, 30-year idea.
Netflix, Apple, some of these big names, Amazon, Dylan, they haven't really been doing much of anything. Amazon actually does close marginally higher here today. Taking a poke over to the retail stocks, those not having fun. Leader to the downside. What's the case here for the tariffs? We started off the show with this conversation and got a little sidetracked, but if we're giving China our fanciest GPUs that have military applications, why on earth are we moving ahead with are we really moving ahead with these tariffs against Canada, Mexico, tomatoes?
I mean, I think you, I don't think you are. I mean, I really don't think that you are. I mean, I know that they are, but I just don't think it'll last. I think that the tendency that this, I don't believe the Republican Party wants to be responsible for an economic catastrophe and be known as the biggest group of idiots since Liz Truss, which if they go through with this, they'll be known as the American Liz Truss. And I think that they know that, I mean, and even if they try to go full Liz Truss, I believe the bond market will kick in here in a much more aggressive way. And the stock market. I mean, this whole thing's going to get flipped all over itself. And then it's going to be Donald Trump yammering with Peter Navarro and Howard Lutnick, and they're not going to have many friends.
Well, Trump's been touting the stock market again. He's been touting the stock market again, and at the start of this week, first call, we were talking about the, concepts of the taco trade. Trump chickened out because the bond market got yippy. Until the bond market gets yippy, he can't chicken out. So this is literally a game of chicken of who's going to move first. Is the bond market going to freak out to get Trump to back down, or is the market going to tell Trump, this is all fine, do what you're doing? Because that's his perception. If stock market's near all-time highs,
no problem.
No problem. You know, and markets go up and down over time. So like the S&P, yeah, it's off here today, but
this is nothing.
If you're one of his advisors today, what are you telling the president? Mr. President, yeah, we had inflation data due out today, and NVIDIA had their chip announcement. Market's happy. NASDAQ hit a new all-time high during today's session. And that's not false, that it did happen.
Yeah.
Do you think the guy's like, oh, yeah, I should back down? No.
Well, this is the whole...
Obviously not. However...
So we have to go one turn of the barrel before...
Yeah,
exactly.
Again. We're going to have to unload one round from the chamber to get everybody's attention, just like you had to do in April.
Well, this is the whole thing, right? And I'll borrow from what I was texting Chris overnight, because I think this is sort of where my head's at now. The only thing better than the news cycle of taking a thing and essentially setting it on fire, breaking that thing, is fixing what you just broke, and then the only thing better is to break it again. Because what that does is it creates this perpetual tension and instability that then becomes the negotiating tactic itself. It creates so much volatility for everyone involved that everybody just goes, oh, the hell with this. Let's just figure out some way to mollify this for 3 years.
Which is 10% on everything. Shut up and go home. How about that?
Yeah, can we just table this nonsense for the next 3 years? Just give him what he wants. He'll be gone in 3 years, and then we'll deal with whoever is left. So you get the sense that all this is just more circus. And I think the markets are there. I think the markets get that at this point. I think the markets had the concern in April that this was more than just a circus, because it looked like for a second there with the foam board that what the U.S. is going to do is surgically extricate itself from the foundation of a financial system that it built on top of itself. Basically, like the foundation of your house decided to dig a tunnel and leave. And then everything that's on top was just like, oh, well, figure it out, buy some stilts or good luck. And
that lasted a week. That lasted a week. It became very clear from April into now the beginning of July in the exuberant performance of the S&P that was not a real thing. That's not what the risk is. And if that's not the risk, then this is all a circus.
Can we throw a new fun risk in there?
Yes, please.
As of today, the RFK-led Health and Human Services has announced that currently 1 in 148 Americans has COVID-19. 2.268 million cases going around.
Is that a good number or a bad
are doing it right now?
Transmissions up 38.1% week over week.
It's a rough version of it too.
So what are you saying?
Nothing like a summer flu to lose some weight before the beach, Dylan? Are we going to go through
like you're thinking. I love silver linings, baby. I like the silver lining. You're going to look good when you come out of the vomitorium.
There is the bull in me that's like, what can we do to get some? We've done this before. We've looked at like Novo Nordisk.
Biotech's come back. Biotech got face plastered. It has come back a touch.
I don't know. Maybe we did this. What was it, back in May or April when we had the bird flu going around just in case, and it almost worked out. We had like $10 calls, and it did rally up to $9. Unfortunately, they never printed. But I don't know. What tail risks are out there right now, Ellie? I think this is the question I'm thinking of myself. And actually, Dylan, I want you to go first. What are the things that the market is treating as, we're a little too complacent about?
Probably tariffs.
Probably tariffs.
Because I couldn't be more complacent. I mean, I still think the outlier risk is that the tariffs are more real than my dismissive and condescending attitude would suggest. So, I mean, but I don't think I'm the only one. I think the entire stock market has looked at tariffs like a non-factor since mid-April for all the reasons we've talked about ad nauseum. And I do think if you're just, I think that the risk of some sort of tariff chaos is probably underpriced. Although were the tariff chaos to emerge, I'd be a buyer.
I mean, so I think that is both right, and we need to make the distinction when we dismiss the tariffs that there's the tariff soap opera, and then there is the economic consequences. And while the soap opera is that, the economic consequences are very real. And so at some point, and maybe that's right now, because that's sort of how this was in February, the markets went, yeah, we don't care about the soap opera. We care about the economic consequences, and we don't like those. We're afraid. And then when the soap opera eats up all the air in the room, you go, yeah, but this is the soap opera. It doesn't matter. And then the data doesn't show up. It's only the soap opera you're talking about. So it's tariffs, and it's tariffs. And the one angle on it is a complete nonsense clown show. But the other side of it is a very real economic consequence.
Guys, we only have a few minutes left in the show, and I was figuring that we could throw in a little bit of a fun segment here to lighten things up at the end.
We're not having fun. I'm having fun. What's the issue?
Listen, I'm having
more fun.
Listen, sometimes you say things. I thought I was having fun last night when I was talking about the NVIDIA thing. It's like apparently the administration's plan is to give China chips and tariff our allies and not release the Epstein files. That rubbed some people the wrong way, as I learned in my direct messages.
It did?
Yeah, I'm surprised considering what some of these people's Twitter profiles said and some of the things they retweeted. They certainly give off the vibe of like F your feelings. And so I figured, a fun joke wouldn't be so terrible. But let's have some fun here at the end. What are we watching? What are we reading right now out of our free time out of work? What are we doing to stimulate our minds outside of the office? It doesn't need to be learning. It could be something complete crap. Ilya.
I have been listening to this new Clips album on loop since it came out on Friday. It is a masterpiece. It is an instant classic. If you're any fan of hip hop, go get it.
Dylan, surely you have something interesting going around in your life?
Push-ups and pull-ups, 100 a day. 100 push-ups a day, 50 pull-ups a day, and then more push-ups. I'm on a push-up and pull-up madness situation, and I find it mentally therapeutic, and I recommend it to all my friends. I suggest more push-ups, more pull-ups, and less cigarette smoking.
I'm with you. I'm up to 192 on push-ups, though not consecutively.
No, of course. But
of
no,
course.
neither me. But I couldn't. Why I believe the push-up is the greatest unappreciated exercise. No equipment
100%.
Just get out of your chairs. Don't be an idiot. Get down there, do the work. It's not that hard. I might do some right now.
At night, after I put my kid to bed, I've been getting on my treadmill and putting on the Odd Lots podcast and just walking for 30 minutes.
Nice.
Like it's not an after dinner walk because it's dark outside, but like it's something to do. I find that actually really stimulating to just like unwind.
I think walking is probably the most underestimated thing in the world. I believe you got to walk.
Gotta walk. In fact, it's a good time because the markets are now closed, so I can go exercise. You guys can stick around for Ilya because he's here for macro money and overtime is out of time. So for Ilya Spivak, Dylan Radigan, I've been Chris Vecchio. Good luck trading. We'll see you tomorrow. Same time, same place, as always here on Tasty Live. Keep watching. See you soon.
Well, it finally had to happen, I suppose, and now it has. Inflation data has spooked the markets. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. We finally got the CPI report to unnerve investors in all of this tariff drama since the beginning of the year. We're going to break it down here and see what it was in these numbers that the markets so disliked, what it means, and what are next steps here. Of course, as ever, we've been watching this story in the context of a disconnect that's emerged between what the markets expect for Fed policy and what the Fed itself has been saying. And today, we have a very emphatic check mark in the Fed's column. And what the markets have done is they've interpreted that information as one might expect, by saying that the rate cuts are probably coming still, just later and more forcefully. So we'll see here what the market response has wrought. Here's the performance across major markets for today. The NASDAQ basically flat, but that undersells the level of weakness. It was, in fact, up at a new record high earlier, following overnight news that the Trump administration is going to let NVIDIA have a more free hand in selling to China. So the Mag 7 complex and sort of the AI constellation of stocks and tech in general had a good day. But for all of that, for all of the run-up in the NASDAQ here, we end up with a net, let's call it flat close and be somewhat generous. Because at one stage here, the NASDAQ was actually up by a meaningful amount here. From yesterday's close to today's high, we were up almost a percentage point, 0.8%, and we're closing having erased all of that rally. So quite the downswing here. The S&P for a sort of more catch-all view down almost 0.6%, yields up across the curve, 10-year up 1.2, 2-year up 1.28, oil down, gold down, the dollar up across the board, Bitcoin selling. Fairly classic kind of spooky interest rate environment kind of risk aversion across the major markets here. Gold probably the most impressive of the bunch because this 0.7% swing is quite modest compared to what you might expect in an environment where yields are up over a percent and the dollar is as strong as it is. You might have expected to see gold lose a lot more ground. It ends up swinging lower, but still well within the range that it has occupied basically since late to mid-June. So going back to sort of the overall story here, the 4-week, 3-week range in gold, 3 weeks back and then this week, it holds on this, which perhaps speaks to its resilience in the face of what is a shaky environment for risk sentiment. We get this data today, and it's basically in line with expectations at the headline, 2.7% for the headline inflation rate, just as economists had it penciled in. The core reading a little bit cooler, as a matter of fact, 2.9% versus 3% expected. One might expect this was, for the most part, good news. But when you look at the internals here, a number of things immediately stand out. It's certainly no shock that what you have is still most inflation locked up in core services. No surprise there. Core services is overwhelmingly the largest part of the U.S. economy. most of the inflationary impetus, or frankly, disinflationary impetus. Most of any kind of reflection of the economic growth to price connection should be in core services, because it is the biggest part of the overall economy. The thrust for overall inflation dynamics will invariably come from this side of the ledger. But having said that, we are seeing the most significant contribution from goods that we have seen since 2021. Last time that we had something comparable like this, and it's not a lot, it's only 0.13 percentage points here of the whole. It's by no means a large contribution. So if the headline is 2.7, 2.24 of the 2.7 is services. No surprise. But the delta in the change here is much more eye-catching. Notice the headline up 0.3 percentage points. The increase from services, the contribution from services, is up just 0.02 against 0.08 for goods. So the swing in goods, the thrust in goods, is 4 times that what you see in services. And this is really the main situation here. Now, obviously, energy gets you a little bit of an uptick for reasons having to do with spiking energy prices around geopolitical risk, and that's probably a fleeting thing. But that's hardly what is the main concern here. It is this. Because what the Fed has been concerned about the entire time that they've been commenting on the implications of this new tariff regime that we've seen emerge since the beginning of the year and its implications for policy, is that the Fed doesn't know how this is going to go, but historically, you get this jump in inflation from a tariff, because what a tariff basically is just a consumption tax on imports. And invariably, what it does is it makes those imports more expensive. Just tax on an extra cost. And that is something that the Fed does not want to extend out into broader inflation expectations, because then all of the progress that the Fed has painstakingly secured becomes challenged. The Fed has, through a very spirited rate hike cycle, the most spirited, one might argue, since Paul Volcker in the 80s, secured a decline in inflation from north of 9% by a hair back down sub 3. So this is not anything the Fed really wants to let out of the bag at all. It wants to keep inflation expectations anchored. And for the most part, it's been successful in doing that. But when you see this kind of a shock start to actually show up in the data like this, as an initial early step, perhaps, foreshadowing more downwind, you start to lose faith in the ability that the Federal Reserve is going to be able to cut rates with any kind of significant impetus this year. And so indeed, as a response to this data, the calculus for the overall shifts a bit, but really the view for 2025 starts to move into territory where the markets are now less dovish than the Fed's own outlook. As of today, we're down to 39 basis points for this year, but we are out to 68 basis points for next year. In other words, what the markets are saying is that the Fed has less capacity to cut rates this year than even it has accounted for. But that what this will mean, what this delay is going to mean, is that the Fed is going to have to cut more later. In fact, notice where we are here. This setting for the 2025 Fed outlook matches us back to where we were here in mid to late February. And of course, this is where the stock sell-off began around the rollout of the tariffs as they began to spook business and consumer confidence surveys, and the markets thought this whole thing was a growth risk. Note that while stock markets have rebounded since all of that story seemed to crescendo in early April, but policy expectations have been anchored in a range. And the only thing that's changed, if you'll notice here, is there's a lot more gray here than there is yellow. In other words, the markets thought most of the peak 137 basis points in cuts here would come this year and a little bit next. That script has flipped. Now it's most of them are going to come next year because the Fed couldn't move and is right to be, frankly, dragging its feet for this year, according to what the markets now say. Compare that with what the Fed just updated for its summary of economic projections in June, and you have 50 basis points for this year, the median rate now 4.4%, so down to 3.9 is 50 basis points. That's 2 cuts. For next year, as of the latest update, the Fed slashed a cut out of the 2026 outlook because ostensibly it feels like the full tariff impact will take longer to see because of delays in the data and because, of course, the tariffs themselves have been constantly paused and variously diluted. We have another cliffhanger on the reciprocal tariff architecture coming up just next month. And so the Fed is only seeing 25 basis points next year from 3.9 to 3.6, and then another in 2027, though that's most likely a bit far to really have accurate forecasting. So the market is at this point at 100 basis points. The Fed is at 75. That feels like not the greatest disparity. But then you consider for next year, the market is at 68 basis points, so leaning in the direction of 3 cuts. And the Fed's at 1. And what that starts to say, of course, is that what's going on here is the markets are disappointed. They wish the Fed would go sooner. They've wanted the Fed to go bigger than the Fed itself has forecast. In fact, here was that update in June. The Fed's been on the dovish side of it basically since it came out. But it thinks that there will be an inability to act this year to the extent that they'd like. And so they think there's an exchange rate between rate cuts now and later. And that exchange rate means that for every rate cut you miss this year, you're going to have to do more next year. Not just move the cut in time, but actually do more cutting, because what you'll end up with is a delay that then lets the economy become weaker, and then you have a bigger stimulative job that needs doing. With that, we have another batch of inflation data that's due tomorrow, and while the PPI index, the producer price index, is not typically the most market-moving thing in the world, this time around, we might actually get more action here. In fact, we've been seeing more action here for the past several months. Now, we can see the expectation is that the overall headline PPI will come in a little bit from 2.6 to 2.5. And the core will come in from 3 to 2.7. But where that downswing comes from is tremendously important. Because one of the things that we've increasingly noticed here is that weakness in PPI has come at the price of wholesalers giving up margins, giving up essentially profits in order to insulate consumers from tariff-linked inflation. So consider what we have right here. And this, of course, is something that is back to where we were looking here in April's data. It didn't show up in May, but this right here, this major spike down in the trade services component of PPI is telling you that margins are getting squeezed for wholesalers. They recovered a little bit in May, but only a bit. Whereas this swing down right here, as we can clearly see, was the biggest one since back here in COVID times. And so what we end up with then is a situation where we have now the biggest squeeze shaping up on margins since basically recession equivalent dynamics right here. So it's telling us that the resilience we've seen in CPI up until this report really was something of a mirage, because wholesalers were eating the inflation. And while they are perhaps still eating some of it has started to show up in CPI. If you now get a PPI report that's weak, and the reason it's weak is because margins are getting squeezed once again, and perhaps further, well, then all the architecture of an inflationary scare from the tariffs is on display. And from the market's perspective, it was always about the growth implications of that scare rather than inflation expectations. We go back to how the markets performed in the first 6 months of the year. We broke this down granularly last week, but we'll revisit it here because it seems appropriate. What we saw in the first half of the year, for all of the hand-wringing and for all of the concern around what's going on in the U.S. and all the extra risk associated with the tariffs and maybe the Fed won't cut, rates fell in the first half of the year, both at the front and the back end of the curve. And that tells us two things. At the front end, it says the markets are pricing for cuts. At the back end, it says there is no credible sovereign risk, that the market continues to happily buy U.S. government debt and have faith in the U.S. sovereign as a borrower. And so it is not surprising then when we get the kind of performance that we get out of this news and out of this whole story today. We get higher yields and the dollar strengthens. We see the dollar behave as the anti-risk haven type of creature that we've been used to, not the Sell America dynamic that appeared in April around the panic linked to tariffs then. And so we get into a much more kind of classic setup here, where if the PPI data is going to reinforce this sense that there is in fact an inflation scare, the implication for markets will be, oh, well, that's probably the one-off, but the follow-on is the growth hit. And that's how you reconcile. We have cuts. There is no sovereign scare. But a cyclical commodity like crude oil, for all of the fire and fury in the Middle East fell 9.2% in the first half of the year. And in fact, if you unpick the makeup of the 10-year yield here, as we've been doing, into duration risk, that is term premium, how much the markets want to get paid extra for having risk of time, and inflation risk, the break-even inflation component in 10-year yields, we find that since the beginning of the year, break-even inflation is mainly trending lower. In fact, it's been mainly trending lower since the end of last year. Whereas sovereign risk, or at least duration risk, seems to be building. And while it's not a US default type of a thing, it does suggest that the markets want to get an extra compensation for time uncertainty. And what that seems to speak to in the context of this is that it isn't inflation so much that the markets are concerned about, it's growth, which is why they want these rate cuts. They're not so much looking to the concern that inflation expectations might get anchored. They're concerned that consumers will stop buying as prices go up and the economy will start to fade. Hence this exchange rate in rate cuts, where the market is not saying, oh, this data means that we don't need rate cuts because, look, the economy is so strong. No. They're saying we do need rate cuts because the economy isn't strong, but the Fed won't be in a position to deliver it, so the economy will get weaker than perhaps it needs to, and it's because inflation numbers are as they've presented themselves, which suggests then that if the PPI numbers are anything like what we've seen over recent months in their internals when they come out tomorrow, one might expect this layout to continue to hold and perhaps an even more significant risk-off sheen to appear across the major asset classes. And that is Macro Money for today. As ever, we are here right after overtime, show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am going to be back with Chris for Futures Power Hour as ever, Mondays and Fridays, though I believe we're off this Friday. I am likewise writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
What is going on, everybody, and welcome back to Risk of the Week. Today's Tuesday. We're back in the studio today. Gus, we got some things to talk about, brother. But what's going on? How are we doing today?
Yeah, man, doing great. Errol's here in the studio in person. This is awesome. I can look right at you while I talk to you. I don't have to look down at the screen to feel like I'm talking to you.
I know.
Yeah, feeling good. Happy to be here. Having an okay day in the market myself. Got a little bit of a sell-off right there at the end, but a really pretty boring day overall. Yeah. As far as that's concerned. But yeah, we're here with Risk of the Week for you guys, bringing this segment back. Errol and I have both put on a position, and we'll be diving into that shortly. But anything macro you want to touch on? What?
Trading around all-time highs, I've never been a big fan of, and I feel like we're talking about all-time highs every other week now. So still trading out all-time highs, still managing. Other than that, have your eyes been on anything crypto related? Any type of crypto exposure? Any type of crypto chats over the last week or two?
I can't say they have. I've been flirting with the idea of getting like just real long, some IBIT, some leaps, something like that. Give me some crypto exposure without actually having to deal with the crypto. Be able to trade options as well is always nice. But I've been waiting for even a slight dip in Bitcoin to present itself for me to do that. Something kind of substantial. It is a cyclical asset to a degree, and it just keeps making all-time highs. And I find with crypto, but strangely not with the regular market, I do find myself in your camp where I'm afraid to trade at all-time highs. Right. And that really is a very backwards logic, and I'm aware of that because crypto makes all-time highs. I mean, much more often than the market. It's not uncommon at all, even now, for Bitcoin to have 100% year. So I don't know why I feel the need to sit on my hands so hard. But yeah, I think it's some long IBIT, like maybe into like 2027, like something deep.
No, I hear you. It just feels awkward. That's the way I like to describe it. It just feels awkward at all-time highs. Feels like the risk to reward isn't too much in your favor, but it's like glaringly a little bit, you might be a little bit more long biased, but just hard to pull the trigger when we're at all-time highs. So that's what we're going to get into for the day, a little bit of a risk of the week. So I'm glad we're talking about this today because there's a couple companies that I got in mind. So I put some thought into this one, Gus, and we can go ahead and just get into the slides for risk of the week now, actually. But NVIDIA, Gus, I'm feeling NVIDIA. I can't remember if I did NVIDIA for one of the first ones, but NVIDIA's at all-time highs. NVIDIA feels like it's not going away. A continued 3-month rally since the beginning of April. Before we even go any further, what are your thoughts on that rally since the beginning of April? We haven't gave back any of the gains considering we're at its highs since April 7th.
Yeah, NVIDIA is an interesting one. Meta was on this same trajectory for a little while, though I do think they've had a small pullback to kind of quell that out now. But yeah, I don't know. I go back and forth where, I mean, obviously anytime something is on a 3-month rally, you know, I mean, what's the thing? On any time frame, it's hard to get more than 3 or 4 green candles in a row before you catch a red candle. And so if we were looking at this on the monthly time frame, we're starting to push that envelope where it does feel like it's high time for a red candle. But also, I mean, NVIDIA is the darling of the market in every sense of the word. I mean, it is the alpha and omega right now. First 4 trillion company in history, #1 company in the world. You say AI, you think NVIDIA. They're making this big investment into their data center, I guess, development center in America to try to take a little bit of that tariff burden off themselves, which I do like. But that said, I do think every stock needs a little bit of time to breathe. And when Meta and Microsoft were also on these cataclysmic runs, right behind NVIDIA coming out of the Liberation Day sell-off, I feel a little bit more wary about that. But with both of those stocks having now taken a turn and at least had their own breathing periods, it feels like it might be time for NVIDIA as well. Yeah, no, 100%. To piggyback off of that a little bit, I mean, kind of feel this is a little bit of my personal opinion. It feels like everybody's in this NVIDIA trade right now. Feels like NVIDIA had a lot of steam to the upside over the last year now. It feels like NVIDIA has been relevant a year and a half, maybe longer. But it feels like everyone's in that trade to all-time highs, and that contrarian in me is itching right now. And then hopefully, maybe earnings could disappoint just with all of the tariff news, all of the uncertainty. I know there's still been conversations around China and their chips and the accessibility with NVIDIA and things like that, but maybe that caused a little bit of a hiccup in their earnings. So maybe we get some negative earnings that'll help my position out if we go ahead and put that position on. And then strong dollar had one. The stronger US dollars makes NVIDIA's overseas sales worth less. That's better for a company with global customers. So look for this NVIDIA pop, right? I mean, I feel like we never got that pullback in NVIDIA. It's reminiscing of that March of 2020 COVID crash that we got in the market, and we never got that significant pullback. It feels like NVIDIA went on an absolute tear, and I've been waiting on that pullback that we never got. So that's where I'm at, Gus. Yeah, to address the concerns popping up in chat, this is, you said 33 DTE is what this trade is for you?
This is, no expiration yet. We're going to go ahead and put this one on tomorrow.
Oh, you're saying, okay.
Yeah.
I got you. We're
going to get short. Short
for sure, but like what are you eyeing? What expiration are you eyeing? Are you saying short stock?
No, not short stock. Too expensive.
I agree.
I wish I could short stock. When you guys know I made it, if you see me just shorting NVIDIA all willy-nilly, 100, 200 shares, just know we made it. But no, contracts, absolutely. Was looking more on the side of, I know we got earnings after the bell August 27th. So that's something to be mindful of. But short, absolutely.
Sure, I'm with it.
Short.
And you mean short term?
Short term, 100%.
I got you.
Short and short term.
Short and short term.
Short term.
All the shorts. Short square.
Short
you guys
square.
Heard it here first.
Short square done.
All right. Yes. And that's obviously true. I don't know how long term I would ever want to be short on NVIDIA. Shorting NVIDIA is like shorting PLTR. Can be painful, but can be profitable. I think we hit the nail right on the head with that one.
Oh, yeah. It's called risk of the week for a reason.
It is.
We're putting a little bit of risk
on. And I'm about to talk about a pretty freaking stupid position.
No, I like I like where you're going with this one, though.
To be quite honest. But yeah, we can jump over to next here. My risk this week is Centene Corporation, ticker CNC.
Okay.
This is one that I've mentioned on air before. I took 2 positions on this one. The first one, which I closed for a loss today, I decided I was not going to let a short put run and destroy my entire year. So I finally had to get out of my initial short put. But this is the second one that I put on. I put this position on 2 weeks ago. It's